Madam Chair.
Okay, if you would please call roll and see if we can establish a quorum here.
Governor Lujan Grisham. Commissioner Garcia Richard.
Here.
Secretary Romero.
Here.
Treasurer Eichenberg.
Here.
Mr. Jennings. Mr. Lavender.
I'm here.
Mr. Rawson.
Pass. No, I'm here.
Mr. Messina.
He's joining. This is Harold. I checked with him today. You know, he had a situation up in Mora, and I just talked to him to make sure what was going on, and he's actually going to join here shortly.
Mr. Tejas. Ms. Allen. Mr. Bingaman.
Present.
Madam Chair, we have a quorum.
Great, thank you so much. Can I get a, yes.
What about me? Tim's here.
Yeah, we called you, Mr. Mayor, and you did not respond. So Andy, would you please call Member Jennings' name so he can respond?
Mr. Jennings.
Pass.
All right.
Okay. Just so you know, I was listening.
So, Mr. Mayor, are you going to give me a motion to approve today's agenda?
I would.
Do we have a second?
I'll second.
All right, we've got a motion by Member Jennings, a second by Member Rawson. Any discussion on the motion to approve today's agenda?
Madam Chair, this is Tim. Could I ask that we amend it and do item 3, D as in dog, after we do 3A as in apple? That would be our first. I just opposed to that one. And I'm in Houston right now. They're going to call my flight in about 45 minutes, and I won't be able to vote on that if we put it clear down at the end. So I'd like to make that as an amendment if I could, Madam Chair.
Is there any objection to that amendment? So moving voting item 3D, the
D as in dog.
the Tau investment,
Yes.
should be our first voting item. So it would be agenda item 3B, and move everything else down. Is there any objection?
Thank you, Madam Chair.
No objection.
All right, so with that amendment, we can take a roll call vote on approval of today's agenda.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Jennings.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas. Ms. Allen. Mr. Messina. Mr. Bingaman.
Yes.
Madam Chair, the agenda is unanimously approved.
Okay. Let's go to the approval of our April 26th meeting minutes, which are in the meeting packet. Do I have a motion?
So move, Harold.
Okay, we've got a motion by Member Lavender. Do I have a second?
I'll second Secretary Romero.
Okay, we've got a motion by Member Lavender, second by Secretary Romero. Any discussion on the motion to approve the minutes from our April 26th meeting? Hearing none, if we could take a roll call vote on the motion to approve.
Commissioner Garcia Richard.
Yes.
Secretary Romero. Treasurer Eichenberg.
Yes.
Mr. Jennings. Mr. Jennings. Mr. Lavender.
Yes.
Just a reminder to everyone, please mute your phones. Thank you. Mr. Rawson.
Yes.
Mr. Bingaman.
Yes.
Circling back to Mr. Jennings.
Yes.
Madam Chair, the motion is unanimously approved.
Okay, have we been joined by Member Messina in the meantime?
Yes, I've been on.
Oh, great. How about we let him vote on this too, Andy?
Mr. Messina, for approval of the minutes?
Yes.
Madam Chair, the motion is unanimously approved.
Thank you, Andy. And I think we had a message from Member Allen that she would not be in attendance today. So, all right. So with that, we're going to move to agenda item 2A and hear from our State Investment Officer, Mr. Moses.
Thank you, Commissioner. Good morning to each of you. Beginning with item A1 on the State Investment Officer's briefing. Total distributions to the state for the last 12 months have been $1,140,719,000. The April 22 contribution from the state land office, and these just keep getting better. $196,2,886. And reminding everyone that there is a 90-day lag on reporting, but just comparing the April contribution from the land office to the March, April at 196 million, March at 161 million. Phenomenal. Thank you, Commissioner. Net asset value of our funds as of Friday, May 20, 35 billion, 3 million. And as of this morning, actually as of yesterday, but the most current number, 35.211 billion. New Mexico intermediate price for oil as of Friday was $109.78 per barrel. And a year ago, that 109 number was $63.44. Quite an increase. Rig count in New Mexico as of Friday was 98 as opposed to 72 a year ago. Natural gas numbers also huge increases from $2.93 per MCF a year ago to $8.08 per MCF as of Friday. These numbers are very encouraging and very welcome. Moving now to item 5, and of course you can review items B and 1, 2, 3, and 4. Item 5, the investment performance has also been good, and we will rely on Vince and RBK for a more in-depth report on those. Under C, council matters, you can see the June 9 and June 28 meetings of the investment committee and the council. We've been through the inflows from oil and gas royalties, other expected inflows, and these are interesting numbers and begin to be celebrated. We're expecting $190 to $200 million, more or less, monthly from the state land office. Stephanie, or pardon me, Commissioner, please correct me if I'm wrong on that.
Absolutely not. That's what we are projecting as well.
Good news. The severance tax fund is expecting about $760 million, maybe more soon. Federal mineral royalties, $1 billion to $1.3 billion. These will go to the Early Childhood Education and Care Fund. So Vince and our investment team are preparing to properly deploy those amounts when they come in, and the timing may be very beneficial. Recovery Fund, the New Mexico Recovery Fund, as you will all recall, authorized up to $100 million for loans to larger businesses in the state. Sunbound Capital managed that for us. They deployed about $90 million. The current outstanding balance is about $54 million. There were several early payments, and we received more than $15 million in payments just this month. There was another loan program, as you'll remember, for smaller businesses funded by the Severance Tax Fund and administered by the New Mexico Finance Authority. That fund currently has deployed about $150 million, and those loans do not need to be repaid for several years. Very lenient repayment terms. The council may or may not ask to begin meeting in person, and the same is true for our committees, and that will be up to each of you to discuss today. Under D, we continue to work remotely as your office, and you can see that we are also still recruiting 3 analysts, one for real estate real return, another for fixed income, and a third for accounting. I'm going to ask Charlie, if you would please, to inform the council about some interesting and positive things that have occurred with respect to our clients.
Thank you, Steve. The Department of Finance Administration has reviewed and approved joint powers agreements with Western New Mexico University and the North Central Regional Transit District. Western will start investing with the SIC in June, and the NCRTD will wait until the new fiscal year in July. That's clients number 24 and number 25 using SIC pools. Luna Community College, their foundation, has made an initial inquiry, and next month their board will decide whether the SIC is going to be the best option for their small endowment. We're still in the initial stages of discussion with the city of Rio Rancho regarding possible management of their new endowment. And Curry County has for now delayed investing with SIC pending a legal review. They have some concerns related to part of state law 6-10-10, which precludes smaller New Mexico counties from some types of investing. Now, our statute's pretty clear, that's 687, that we can do JPAs and invest for political subdivisions of the state. We'll be working with the county as necessary and expect to have additional conversations heading into fiscal year 23. Or in questions, madam, that's my report.
Tony, thank you for that. Commissioner, the only other thing I would mention is that I would ask each of the members to take a look at the dashboard as we do each month. Andy and Brett are doing an excellent job of updating that periodically, make it more readable. That's all we have.
All right. We'll take questions from council at this time. Hearing none, we can move to agenda.
If I could.
Yep, Mr. Mayor.
Yeah, I'm sorry to bother you. This is Tim, and I have some problems. I have a council meeting going on next door as well. At this time, we're doing our budget, and I have to be in both places, so I will be in and out. Okay, and that's probably helping for your voting stuff, but I'm sorry. If there wasn't any way else I could change it.
Thank you for the heads up. All right, do we have any additional questions for
Madam Chair?
Yes.
The Secretary Romero, just wondering when the appropriate time is to talk about the meetings in person. Is that good? Will we discuss that later, or is this something we want to discuss now?
Mr. Malik?
That's up to the council, whatever your pleasure might be.
We can do that now, Madam Secretary.
So the only thing I'd like to mention is, or I'd just like to let the council know, is that the State Board of Finance did have their first in-person meeting of last week, and it was held in the Governor's Cabinet Room. And so I think they're open now to having things return back to normal and having meetings in person. And so if you were waiting on that decision, I think that we can probably move forward with in-person meetings, if that's the will of the council.
Commissioner, let me ask Brent, if I may, to comment on whether there could be any technological issues with coming back in person at this time. Brent, do you think that could work?
I definitely think it could work.
Thanks.
So would you make an inquiry on behalf of the council, or Mr. Moise, to the governor's office for the scheduling of the cabinet room, just to ensure that we can, be there for our June meeting?
We'll be happy to do that.
Any further thoughts on in-person meetings from the council?
I'm certainly in favor of in-person meetings and can't wait to see everybody.
And as we have in the past, I don't know if you guys remember, but we did have the telephonic option for folks who cannot be in person as well. Will we still have that available, Steve?
Red, is that doable?
That would be my plan.
Thank you.
And then I cut someone else off that wanted to chime in.
Madam Chair, this is John Bingham, and I am going to be traveling a bit this summer and would definitely like to join telephonically, so would request that we make every effort to make that available, please.
Okay, thank you. Anyone else? All right, so hopefully we can have our June meeting in person. With that, we're going to move to agenda item 2B if there's no objection, and we'll hear from Mr. Smith, our Chief Investment Officer.
Well, thank you, Madam Chair. Good morning, and thanks for the approval of the agenda. I think we've got some good investments on here for you to review, and then we'll follow those up with the strategy piece that we normally give you, the black dot chart. That just shows you sort of how we're positioned relative to peers on a go-forward look basis. So RBK reports to you quarterly on how we've performed relative to peers, historically. This just does the other side of it, shows you how we're positioned on a go-forward basis. But we'll run through that with you here in a little while. Since the last time we met, the macro picture hasn't changed too much. The inflation that we're experiencing is real and not transitory, as the Fed administration judged several months ago when prices first started to surge. And so the Fed's realized this and is actively taking steps to address. However, as we've talked about in past meetings, not in its history back to creation in 1913, as the Fed fought inflation with increases in short-term interest rates, that has not caused a recession. So we do expect the activity by the Fed, which is raising short-term rates and starting to cut back on the quantitative easing it was doing. We do expect that to cause a recession. We've been targeting the last quarter of this year or the first quarter of next year to be the first quarter of that session, and nothing's really changed since the last 3 or 4 meetings that we've talked about this with you. Nothing's changed over that interim to kind of push us off that expectation. We're already starting to see the economy slow. Earnings reports for the first quarter are coming in mixed. Corporate earnings are coming in mixed. Housing's definitely slowing. We're seeing that. And we expect we'll see the labor market begin to slow just a little here soon. And of course, markets are responding. Longer-term interest rates look like they're stalling here around the 3% level. I think we're at 270 today on the 10-year. So kind of stalling in that area and starting to maybe move a little bit lower. And of course, stocks are falling. The S&P briefly dipped into bear market territory last week, as defined, by being down 20% or more from the last high. It bounced up a little bit, but it looks like with today's activities, we're down, about 2% right now on the S&P. We may be back into that bear market territory. So things are slowing, stocks are responding, interest rates are responding. Fed's out there. The Fed has made a big commitment to fight inflation. Chair Jay Powell was out with a rather long announcement, a rather long discussion.
Hi, it's Kathy. I'm on.
Great. Welcome, Member Allen. You made it.
I did. Thank you to Andy. She got me the right number, so.
Wonderful. We're just in the middle of agenda item 2B, our Chief Investment Office report.
Okay, thank you.
Okay, well, welcome. So just to finish up, the Fed looks like it's steady in combating this inflation. Some economists think we've hit the high at 8.6%, and it should be coming down. So we'll be looking forward to that. But those increases in interest rates and Fed activity, we think are lower on economic activity and likely lower on markets. So keep our eyes open for that. As you know, we positioned previously for markets, and Marcia and Matthias will go over the performance report with you and kind of show you how that's played out for us. When we get to them. So I think with that, Madam Chair, let's see. Just one other thing or a couple other things on operations. The searches or the two searches we have for analysts are going fine. We're getting some interest and some interesting folks. So I'm hopeful we'll have some announcement, in the nearer term, I should say. And we've got one of our folks sitting for his level 3 of the CFA exam on Saturday. So Asa Scott, good luck to you, and hope we have another CFA on staff later this summer. So that's it, Madam Chair.
Great. Do we have questions from the council for Vince?
Madam Chair?
Member Messina?
Yes, not about this report. Are we going to have in-person committee meetings as well as the council meetings?
Well, this is Harold. I certainly want us to have the in-person investment committee. If we're going to have the in-person SIC meeting, I certainly hope we have this. If it's okay, we'll plan to have the investment committee meeting in person in June.
And Commissioner, we'll let everyone else know about other committee meetings.
Okay, great. Any further questions for Vince?
Yeah, Commissioner, I know Vince mentioned that Asa will be taking his CFA exam. Bruce, would you comment on your CFA activity?
Sure. Yeah, I'm also going to be taking the CFA Level 3 exam this Thursday. So it should be a very interesting stuff. Looking forward to it.
Thanks.
So good luck to those folks. Hearing no further questions, we're going to go to RBK's performance report, agenda item 2C.
Great. Thank you, Madam Chair, Vince, for the comments, and good morning, everyone. Today in the meeting packet, we do have your March executive summary that we plan to go over. As usual, I'll provide an overview of the capital market environment, try to add on to what Vince had already mentioned, and then Marshall will discuss the performance of the funds. For those looking and diligent, we can start on page 17 of the meeting material. That provides the, I would say, high-level overview of the capital markets. You can see economic indicators in the left, and at the bottom table, the market performance for the various trailing time periods. In that table, you'll notice, as always, equities are categorized at the top, capital preservation in the middle, and your diversifiers, also inflation hedging assets clustered at the bottom. I think the first thing you'll notice this quarter, as you look at this, is that there is quite a bit of red across most of these asset classes. And the overarching theme for this first quarter of the calendar year is that market volatility is increased meaningfully, certainly compared to what we've seen in the prior quarters and prior couple of years. And that's largely been driven by a confluence of different factors, most of which we've previously discussed, but at this point has migrated into inflation that's not transitory, but rather persistent. Of course, the Fed raising interest rates ongoing and very unfortunate geopolitical tensions that we've discussed, and now also lower economic growth forecasts that Vince alluded to. So all of that really led to a quarter where nearly all assets struggled, and in particular those traditional asset classes which have been on such a good run since the GFC, since 2008, when we had the great financial crisis, and we decided to essentially step in and provided liquidity and cheap financing anytime the market went the wrong way. So that era seems to have come to an end, and those asset classes which have been bid up tremendously over that decade have most severely come under pressure in this first quarter, and also has continued really into the second quarter with at least no immediate end in sight. Vince mentioned that we may very well see a recession later on this year or early into next. And so that really has changed in terms of the paradigm for what's worked, isn't working now. That was in a lot of ways to be expected, and a good reminder that diversification is in fact useful. Inflation-sensitive assets do in fact have a place in the portfolio, and those asset classes which have been essentially unloved and shunned for that decade are now really pulling their weight, and good to be in there. You all have been, I would say, very thoughtful in terms of incrementally diversifying away from those very expensive traditional assets that are also duration sensitive in a lot of ways, and move away, recategorize your risk exposure into things that are going to be less susceptible for a correction, and of course are now helping the fund, even though they've been holding you back in this very vertical market that we've seen for the last few years. Vince mentioned inflation, of course, that continues to exceed expectations. Levels really that we haven't seen since the early 80s. The end of March, it was 8.5%. April's figure came down slightly to 8.3%, but that's not much of a break, seeing 20 basis points of a decline. And we've talked about in the past as well that inflation has really migrated into areas that are a lot more sticky and difficult to unwind. So I think the Fed really does have a tough task in terms of reining in inflation. And so we may very well not see the rate of inflation improving until we see a lot of these issues that we've talked about in the past, whether it's supply chain issues, labor market challenges, or geopolitical tensions that are having an impact on a global basis in terms of shortages from food to commodities. Until we see improvement on all those fronts, I think it'll be quite difficult to get these numbers certainly back to where the Fed wants them to be, which is a lot closer to the 2% target. So that really has forced their hand, and they've started raising interest rates in a meaningful way. We saw 50 basis points most recently, and we could see additional rate increases for quite a while. To get up to a place where they feel like the level of inflation, if it does in fact respond, is more manageable. And so you can see that shift in the yield curve in terms of the rates, particularly on the short end. In the bottom right graph, when you compare the yellow line to the green line, that represents just a 1-year change, and it's a pretty substantial move, at least in terms of what we see historically. And as we've talked about, when you have a shift up in rates, that has a meaningful impact to the broader fixed income market, and in fact, in this case, resulted in one of the worst quarters on record. So fixed income markets saw about a 6% drawdown for that period. As I mentioned, assets with more direct linkage to inflation are benefiting. So that could be real estate, commodities, other physical, real, or inflation-sensitive assets, and we expect those to continue to do quite well in this environment, and that's been laid out in Vince's annual plan as well. The second quarter, just briefly, just to give you an update there, many of the trends that we saw in the first quarter have continued there. So for these 7 or so weeks going into the second quarter of the calendar year, year to date, though, equities are down about 17%, going above and below that bear market territory, pretty significant Daily volatility as well, some up, some down, but generally has been trending down, and fixed income has modestly improved from down 10% to down 9%, still quite a bit of sell-off. You'll recall that you really reduced your broad fixed income exposure to account for primarily liquidity, as we've talked about in the past. That income component of fixed income really hasn't been there in quite some time, although it may present opportunities down the road. So I'll stop there in the interest of time. Happy to take any questions related to the markets or other topics before I'll turn it over to Marcia to give you the performance highlights.
Any questions for Matthias? All right, Marcia?
Thank you, Madam Chair, and thank you, Matthias. I would like to take you to page 20 of your diligent, which is page 6 of our packet. This is looking at asset allocation on the left for the land grant fund and on the right severance tax. For land grants, this is again as of March 31st or the first quarter of this year. You can see the deviations. You're only out of target range on non-core fixed income. Vince has talked over the past several quarters about, and thank you, Madam Commissioner, on the money coming in, but getting that money deployed into some of the private asset classes has been more difficult. So you can see an underweight to non-core fixed income real return in real estate relative to your target. Now, the only one that's out of range is non-core fixed income. And at the end of the first quarter, you actually had a slight overweight to U.S. equity. And you'll notice a cash component. Again, that is a point in time, but there was cash in the portfolio, as has been discussed recently as well. Severance tax, similar story, but all within range. Going to page 21 in diligence, you see the asset allocation of the other funds. Just notable here is we're looking through performance, noting that tax stabilization and rural libraries have no exposure to equities, so we'll notice returns there. And then a low allocation for the water trust and tobacco, just 20% in public equities for both of them. And then early childhood, that is in transition, so you'll see a lot of out of ranges as that money gets deployed into its target allocation. Now, just for example, on rural libraries, at the moment when we look at the performance, as I said, there's no equity allocation, but as Matthias discussed, it's been a very difficult fixed income market as well. So in that portfolio, about 80% is in some form of fixed income, the other 20% is in real estate. So it'll be interesting. We'll point out that return in a moment. Page 23, we go to looking at how you perform versus your policy expectations. For land grants, you'll see for the 5-year period that it actually underperformed its policy index. And it was outperforming by 19 basis points at the end of last quarter, but dropped below for this quarter, so 60 basis points below the 5-year expectation. Severance tax typically underperforms land grants, so it had been below its policy expectation for the 5-year period at the end of last quarter, and did so again in this quarter. Looking down below at the performance, all of the information that Matthias provides you on benchmarks and the market environment, you can see your return for the land grant. Net of fees was for the quarter down 1.33. Severance tax was down 1.79. And you can see longer term positive returns for the fiscal year to date, returns at 5% for land grant and 2.7 for severance. Looking at attribution on page 21 of diligence, this first section, the first
page is looking at for the quarter. So just a couple comments about that. As we always talk about, asset allocation really is the biggest driver over the long term of your performance. And that certainly was the case for the quarter. You see, as we mentioned, that for land grant, your investment return was down 1.3. Negative 0.68% was due to asset allocation. And if we look below that to the yellow line that says tactical asset allocation, that really is the impact. And you can see that down below in the yellow. That is really being away from your policy target. So as I mentioned earlier, you have not been able to deploy into some of your private assets. So that was a headwind for you in this market environment, because as Matthias was pointing out, that diversification was helpful in this period. You had that slight overweight to U.S. equity for the period. That was a negative, as is not being at your target for those private assets that performed better. Style was pretty neutral. You had some manager underperformance, which was only down a takeaway of 9 basis points. You'll notice a positive for your non-core fixed income, so positive manager value add there. In this case, for the quarter, you can see a negative under cash. So having that cash and overlay cash strategy was a headwind for you for the quarter. Page 25 looks at the same information, but for a year. Again, the drive, in this case, it was a positive return. So nice to see that. Most of the returns, all of came from asset allocation. Again, that tactical allocation, not being at your target allocation, especially with your privates, was a negative for you. Having a slight overweight to U.S. equity was actually a positive, but not being fully at your private, your allocation target for the private assets was a negative. And then you can see positive manager value add for the year, most coming from non-core fixed income and from your real estate portfolio. The same information is on page 26 and 27. The difference here again, a lot of this is the ETI is a detractor from performance for both the quarter and the year, but the same story is true, not being able to get to your target allocation on some of the privates was a headwind for you. Going to page 28, this is looking at each of the funds, everything combined on the first line, the total fund, that's everything combined, then you go down to the individual returns. This is looking at calendar year-to-date returns. So again, that negative performance. Tobacco actually had a positive return. Remember, low allocation to public equities there. Same true for the water, which is on the next page. So having less public equities and the diversifying asset classes that added value in this period where publicly traded equities and publicly traded fixed income did not perform as well. Next, we're going to go to page 32. And although you underperformed your policy benchmarks for the quarter, it's not an objective for you, as you well know, but we also always show you how you did compared to your peers. And again, your peers is not just sovereign wealth funds, it includes pension funds as well. And the takeaway here is although you underperformed your policy index relative to peers, you did very, very well. Again, having the looking forward and understanding that the run for public equities could not continue, and that yields on bonds, publicly traded bonds, was very low. You've had diversification in your portfolio that paid off, so much so that if you look at under the all public plans greater than $1 billion, see for the quarter your rank was 3rd percentile out of 68 funds. Fiscal year to date, your top decile. For the 1 year, 14th percentile. And then looking down the road, you're above median in each of the time periods now. So diversification paid off for you. You can see for the shorter term. Was there a comment or question? Sorry. We also show you two different universes. One for large plans, 10 billion. You also rank number one for the quarter there. And for all public funds, you ranked in second percentile and quite well, having that diversification, so above median all those time periods for that all public funds. The larger plans are more diversified, so also you rank in the top third. For the 1 year, you can see that that universe is only 17 plans, but also was diversified like you, and your rank was below median for longer term there. Going to page 33, looking at this 5-year rolling peer rank, this is each point in time is looking back at your 5-year rank. The right-hand side of the page is more recent time periods. Most of those bars are above that median, which is our goal to have above median performance over time. You fell down a little bit in that strong equity market and fixed income market. You're bounced back up with your 5-year now, so above median. But then if you go to page 34 as well, looking at Sharpe ratio, which is looking at a risk-adjusted return. So if you're looking at where you are on your risk level, you rank very high there. You're in the top quartile for your Sharpe ratio and have been consistently for quite some time. So that's looking at in that universe of considering what your volatility for the portfolio is, you've done quite well. The following page looks at severance tax, page 35, severance tax also for the shorter term to the 1 year period above median. Severance tax always has lagged for the most part, the land grant, but for the short term, strong ranks for severance as well. And page 37 takes you there. This is looking at risk return. And so the top left-hand chart, the green is the land grant actual. The policy is the yellow triangle, the policy index. And both of those now are in that northwest quadrant, where for that 5-year period in this universe of plans greater than $1 billion, you've had below median volatility and above median return. So that's exactly the quadrant you want to be. Above median returns, below median risk, and you're there. Severance is close, but again, the policy index for severance is doing better than the actual severance tax performance. So again, below median risk there, but not above median return. And right below that, you can see now for the 10-year as well, the land grant is now in that northwest quadrant as well. Page 39, quickly we'll look at the asset class composites and look
Hey,
at
Marcia, excuse me. Madam Chair, could I just interrupt before she jumps up to another asset class? Could you go back, please, to page 30? We skipped over that. I had a question about the tax stabilization. Could you, I know this is first quarter, do you have an update? How's that looking now in May?
So you're looking at the
the TSR, the Tax Stabilization Reserve Fund. I know this is just first quarter, but
yeah, we can. We don't have actual numbers, but with tax stabilization being all, for the most part, all fixed income with some real estate. It's still going to be negative. I don't have a return for you, but as Lucia said recently, fixed income's come up a little bit off its low, but still, in equities, you don't have any equities, but having the fixed income, it's not going to be in positive territory. Treasurer, I'm sorry, I don't have those exact numbers for you.
Okay, well, thank you. Thank you, Marcia. Thank you, Madam Chair.
So looking at asset classes, back to diligent 39, you see where the performance for the quarter, the private asset that's performing for you, although it was lagged, was the real estate composite up 9%, real return 6.4. These are all lagged performance, and then private equity also positive. And then non-core fixed income positive. Then everything else is negative with the quarter, with U.S. equities doing a little bit better than non-U.S. equities. And then, as Matthias pointed out, also core fixed income having a really difficult quarter, down over 5% just for the quarter. Longer term numbers look a bit better, but where you have struggled is in the U.S. equity composite that has been repositioned, trailed some for the quarter as well. Your active large cap growth manager, who has a strong long-term track record in this environment that's not favoring growth, they did a little worse than their benchmark. And also, well, let's go to the U.S. equity composite and take a look at that. I'm going to take you to page 27, where just pointing out that, or diligent 41, where there's been no manager terminations or additions for that time period for the last quarter. This is looking at just your U.S. equity composite on page 42. Net of fees, it was down 5.41, so a little bit worse than the Russell 3000. You'll note right below that for the quarter, large cap did a little worse than small cap. You've gotten rid of your small cap bias in your portfolio, but again, small cap did a little bit worse, although your small cap managers were successful in outperforming the benchmark, as you can see. And again, on the large cap side, trailing the benchmark in most part because of T. Rowe Price. Page 43 puts that in perspective of a risk return, and this is looking for a 5-year period. Again, your total fund is right on the median return line, slightly above, but your portfolio has a little less volatility than your peers. So at slightly above median return at below median risk. And if page 44, just as you're turning the pages, you can see how the portfolio is positioned, how it was positioned at the end of the quarter. So on market cap, looking very close to the benchmark, the Russell 3000, and also sector weight, pretty neutral to the benchmark as well. So some of the biases that had been in the portfolio have been removed from the portfolio. Non-U.S., looking at that asset class, again, no manager changes during the quarter. Page 47 looks at that performance. Net of fees, the combined non-U.S. equity portfolio was down 5.72, here trailing the benchmark slightly, noticing that, as you would expect for the quarter, developed markets were negative, a little bit worse than the U.S. markets. But emerging markets, as you would expect, and especially with what's going on in Russia and Ukraine, that asset class struggled even more, down 6.93 just for the quarter. But looking on page 49, how that portfolio was positioned at the end of the quarter, again, pretty neutral, a little to the benchmark on market cap, and you see your over and underweight relative to the benchmark at that point in time. So a little less in emerging markets and a little bit more in Europe at that point in time. And then page going into your fixed income on page 52 of diligence, both of your fixed income composites are in line with your policy benchmark. Outperformance of the core by 88 for the 5-year period, and 240 basis points for the non-core for the 5-year period. Looking at a shorter term for the quarter, your core did better than the benchmark, so lost 5.21 relative to the benchmark at 5.93. And as I mentioned before, non-core fixed income in a very difficult market ended up having a slight positive return for you for the quarter. And lastly, looking at alternatives on page 55, private equity is at the end of the quarter, although 19 for a 5-year period having a return of over 19.5%, trailed the benchmark by 42 basis points, but certainly can't complain about that return. And then real estate outperforming its benchmark for the 5-year period, and real return, which has gone through a period of trying to fund in and diversify that portfolio, also lagged against its policy expectations. So with that, Madam Chair, Ms. Houston, I would take any questions. A difficult quarter on an absolute basis, but on a relative basis to the universe of other funds, you did very well.
Great. Any questions from council?
Madam Chair, this is John Bingaman.
Member Bingaman.
Just question, I think probably for Vince or staff, but any commentary on the underperformance of real return over the 5-year period? Is there sort of a benchmark issue? Is it sort of the composition of some of our investments in that asset class? Or what do you attribute that to, and what's the outlook for that?
Madam Chair, it's Vince. Yeah, John, the MLPs underperformed our expectations, and that's a big component of that asset class. Most of the rest were in line or better. Infrastructure investments were above plan. Timber and farmland were at, maybe slightly below. But I think the big driver of the underperformance is the end of the MLPs.
Okay, thanks.
Further questions? All right, hearing none, thank you to RBK for that report. We will now turn to investment matters, agenda item 3, and I'll turn it over to our investment committee chair, Member Lavender.
Thank you, Madam Chair. We won't spend a lot of time. We've got a lot of things to cover today. As you can see from the investment committee minutes, we were able to take a look at these 4 or 5 investments, 4 investments and one other matter. And I think that we spent quite a bit of time talking about what you'll see a little bit later in this report about the black dot chart, and Vince will spend time explaining that. So rather than take any more of the council's time, what I'd like to do is to move to our first vote, and turn this over to David Lee and Mercer.
So actually, Member Lavender, we had a...
Oh, that's right.
Right. So
I'm sorry, I apologize. 3D.
Right. So the TSSP Tau investment, so we will turn it over to Mr. Sable and Axia.
Okay. Thank you, Madam Chair.
Thank you, Madam Chair. This is Keith Sable speaking. I'm pleased to report that today will mark the final set of private credit investments I'll be presenting. Happy to say that the cause for that is that Tom Lofton has joined us as the new Director of Fixed Income and Private Credit. He and I have been working since early May on the transition. I can assure you I'm ecstatic to have him on board, and I assure you that the fixed income private credit portfolio will be in excellent hands going forward. I hope you'll all join me in welcoming him to the team. To jump off in terms of investments today, we'll have a total of $325 million in allocations that we're seeking approval for. It seems like the faster we run to keep up with inflows from the land office, the further behind we get. But in the larger scheme of things, that's certainly a high-class problem. Joining me today for the presentation of the Tau portfolio will be from Axia, Trevor Jackson, and he'll quarterback that team. And then Brian Darcy, a partner at Sixth Street, will make some comments on the portfolio. So to jump straight into the presentation, NMSIC staff, in consultation with Axia, is recommending a commitment of up to $250 million to the Sixth Street Tau Partners Fund. The fund targets net returns in the neighborhood of 10% net. You'll recognize Sixth Street as an existing GP in the portfolio. In the October meeting, we approved $75 million into the Growth Partners portfolio and another $25 million into the mid-stage growth portfolio. Tau itself is a $23 billion cross-platform evergreen structure. You can think of this structure as a co-investment vehicle for smaller funds across the Sixth Street complex. The strategy is to identify the best risk-reward situations as that opportunity set migrates given market conditions. As a result, Tau is going to be broadly diversified across 9 different strategy verticals. These include growth, opportunities, fundamental strategies, specialty lending, infrastructure, agriculture, insurance, credit markets, and adjacencies. This extreme breadth in the strategy is a principal driver for the scale of the requested allocation. The growth vertical will comprise the growth and mid-stage growth funds that we had previously allocated capital to. I stand corrected, actually, that was November, of 21. The maximum overlap between the strategies would be approximately 15% because of the sector constraints on Tau. The infrastructure, ag, insurance, and adjacencies verticals would be strong diversifiers for the private credit portfolio. The adjacency vertical is essentially a catch-all that can include a variety of investments such as healthcare royalties, life insurance settlements, and other things that don't fit directly into one of the other verticals. Because of its cross-platform investment design, the fund is not guaranteed allocations in every deal in each vertical, but in practice, the overlap is likely to be on the order of 85%. The unique sourcing capabilities that we talked about when we did the growth and mid-cap portfolios are key drivers of diversification for the portfolio. About 3/4 of the Tau portfolio, or in about 3/4 of the Tau portfolio, Sixth Street is the only party involved. In approximately another 10%, there's only one additional GP involved. So it's very unlikely that these positions will wind up in other portfolios across the private credit sleeve. As in the growth and mid-stage growth funds, the investment approach across verticals includes a focus on structuring for downside protection with the potential for upside capture. This results in a portfolio that skews heavily toward first dollar risk. That's on the order of 40%, and other securities with equity cushions of at least 75%, which accounts for another 1/4 of the portfolio. One of the unique things about this fund is its evergreen structure. It's designed a little bit different from some other evergreen portfolios in that the initial investment period, this fund will work like a normal drawdown vehicle. And after about a 3.5-year window, we'd expect the fund to be fully invested. At year 5.5 and every second year thereafter, the SIC may elect to opt out, in which case the fund would act again as though it were a typical drawdown vehicle and liquidate over a standard wind down period. Otherwise, the proceeds from investments, the realizations would be redeployed into the portfolio. We think it's this capital redeployment that will help keep the average capital deployment in the private credit book higher than it might be were we looking at another drawdown vehicle. On balance, staff believes Sixth Street Tau Partners offers an attractive diversifying total return opportunity for the private credit portfolio, and we're recommending an allocation of $250 million to be approved. This would reside in the distressed and other sleeve of the private credit allocation. With that, I'll turn over to Trevor Jackson to make a few comments, and then after Axia, we'll hand the floor over to Brian Darcy from Sixth Street. Trevor?
Thanks, Keith. Good morning, Madam Chair and council members. Trevor Jackson at Axia. As Keith mentioned, we're bringing Sixth Street Tau for council approval this morning. It falls in that distressed other category of the portfolio and really just provides good flexibility and diversified credit exposure. The Tau structure we'll have exposure to direct lending, opportunistic credit, growth capital, and just other adjacencies that really fall that opportunistically for 6th Street. As mentioned in prior meetings and on today's call, given the increased utilization of the non-core fixed income portfolio and general growth in the overall portfolio the last few years, the level of portfolio pacing is needed to increase, currently sitting at $900 million target for 2022. As a result, 6th Street TAO provides a good core holding towards that pacing. And as we were recommending a larger than usual allocation of $250 million. Normally our bite size is around the 150 as we've talked about. And as Keith mentioned, 6th Street's a manager that you currently have in various other funds and prior TAO vintages. So I'll turn it over to Glenn Morisano, who is in our research team, to walk through the 6th Street strategy. And Rebecca Hune is also available if there are any ODD questions that come up. Glenn?
Great. Thank you, Trevor. Hi everyone. Glenn Morisano with Axia on the line. 6th Street Partners is led and by former senior colleagues who were also originally investing a similar strategy at Goldman Sachs' U.S. Special Situations Group prior to the financial crisis. 6th Street today has roughly, or as 2021 year end, has roughly $61 billion in assets under management. The TAO capacity that come up will provide the plan exposure to core 6th Street strategies, as mentioned, including opportunistic credit, distressed, growth lending, as well as others, but also to adjacent situations for which 6th Street does not have a current dedicated pool of capital, insurance being one that's topical. Since inception, TAO has invested over $20 billion throughout its life and has generated attractive growth and net returns across its different vintages since its inception. Across from a merit perspective, 6th Street's track record within TAO and across the board stands out relative to its peers in both private credit and opportunistic credit. We view Axia is quite familiar with 6th Street and has a considerable amount of time with the platform across its client base beyond these existing diligences. The senior team, as well as mentioned from Goldman Sachs' balance sheet special situations business, has been able to recruit top investment talent, and the senior team has remained largely consistent since its inception. Often 6th Street is the only or lead investor in its transactions, and as such, we find their deal flow to be differentiated in the marketplace. Additionally, the platform is global, with operations in the U.S., Europe, and more broadly, which ultimately allows for a wider deal funnel to come through for both TAO and its broader businesses. And as the macroeconomic landscape is changing, whether it be increased corporate stress or dislocations in markets more globally, we do think that 6th Street and the TAO fund is in good position to capitalize on any dislocations or further market stress, as the platform has done globally across whether it be secondary credit or private credit or structured transactions. And so with that, with certain considerations around the growth of the platform and perhaps allocation policy, all things considered, we do view that the allocation is a good fit for New Mexico, as well as for the opportunistic credit landscape more broadly. With that, I'll pass it to the 6th Street team, unless there are any questions, but thank you for your time.
Great. Thanks, everyone. This is Brian Darcy. I've had the good fortune to be able to present all of you in the past and most recently on our growth fund a couple of months ago. I really appreciate the opportunity to do so. I also caught the beginning of this and heard that these might be coming back in person, so hopefully we can do these in person sooner rather than later. Within 6th Street, just to reintroduce myself, I'm one of the partners here where I sit in our investment and allocation committee and head up capital markets and strategy for the firm. A lot's been said about 6th Street and TAO already today, so I'll try to keep my comments pointed, but also just cover a couple of different areas that the folks who spoke before me did not talk about. I believe in your packs, the pages on 6th Street start on page 237, and I'll just reference a couple of pages beginning with page 242, which should say the 6th Street platform page. Look, as both Glenn and Keith talked about, TAO is our flagship vehicle.
TAO is a $25 billion portfolio that spans all the different business units, sector teams, themes, and dislocations across Sixth Street. It is a single portfolio of risk where we invest in private, public, debt instruments, credit and special situations, really a best ideas portfolio that all of our largest LPs have their larger allocations. It is a evergreen style vehicle where LPs such as yourselves can continue that exposure as long as they want without having to do Fund 2, Fund 3, and Fund 4 with different controls and mechanisms where they can opt out. And I put it pretty simply, if people say, hey, I think the style of Sixth Street's investments, which I'll talk about, are the type of investments that we find interesting amongst all the various funds we manage and things like that. TAO is really the purest expression of how we invest here at Sixth Street. The two kind of hallmarks, and our partner group now has been investing together for over 20 years. The two hallmarks of how we invest a broad, opportunistic, credit-oriented fund like TAO are really two things. Number one, Sixth Street, we are a theme-based investment firm. And what that means is at any point in time, our partner group will have 30 to 40 different themes or dislocations that we're trying to allocate capital and be an investor. And our business for over 20 years now has been a constant rotation among themes which have run their course moving off, new themes being added, and a constant rotation and migration in this kind of omnivorous model, finding what we think are the best and most interesting themes to invest behind at any one period of time. Now, some of those themes may have a shelf life of only 6 to 9 months. Others might have a shelf life of 2 to 3 years. It's totally dependent on the market environment. And because of the flexibility of the TAO capital, it's a pretty unique vehicle which allows LPs to get various types of themes and exposures across the whole spectrum of private credit and opportunistic investing. And then the second is a maniacal focus on downside protection. Across our 20-year track record, we have continuously compounded capital for our LPs. Most notably, when we were at Goldman Sachs, we were the only desk in 2008 not to lose money, but actually protecting capital in probably the toughest market environment in our lifetime. And if you look at the type of risk units that we dial in TAO, we tell our LPs to expect unlevered, majority top of the capital structure type risk units that will be unique to the TAO portfolio, diversified across different assets, each individual investment highly diversified at kind of 1% to 3% position sizes, no sector being more than 10 to 15% of the aggregate whole. And in exchange for diversified, downside protected, kind of compounding portfolio characteristics, we should achieve, base case returns of kind of low to mid double digits with upside notes from there. And that's exactly what TAO has delivered over the previous years. If you click forward, and I'm going to count out loud because my pages are different than the ones you're looking at, 243, 44, 45, 46, 47, 48. If you flip to 254, there should be a good page, which I'll just wrap up my comments on and pause for questions. There should be a pie chart page that says the TAO Global Portfolio. This gives you a sense, about a decade now into having managed TAO, the types of assets and the types of portfolio you can expect. On the top left, you see it's pretty well diversified across all the various business units and subgroups that we manage here at Sixth Street, has been talked about by Glenn and Keith. From a geography perspective, we're a developed markets focused firm. So the vast majority of what we invest in will be North America, and then the balance will mostly be in Europe. On the bottom left, from a capital structure perspective, when I said we're generally going to be top of the capital structure type of investors, this shows you that about 2/3 of our investments are focused on that part of the capital structure. Cash yield, we purposely dial, again, a majority unlevered portfolio top of the capital structure, but that also carries a cash yield. And so the entire portfolio today, nearly 80% is a cash yielding asset. And then to the right, and this is perhaps the most important pie chart on this page to us because it speaks to how we think about our thematic approach, but also our sourcing model that Keith talked about. For a portfolio this large, TAO is a $25 billion fund. Approximately 77% of it has no overlap with any other GP. You can't find these names in a different fund. It's an incredibly unique portfolio. So that's what to expect from TAO. I'll kind of pause there if there's any questions. I know the three of us have gone through, or four of us have gone through a number of items on 6th Street and Tao, but why don't I pause there and take some questions?
Thank you, Mr. Darcy, and we will now go to council for questions. Either of our folks here at SIC, AXIA, or the representatives from 6th Street. Any questions?
Madam Chair, this is John Bingaman.
Yes, Member Bingaman.
Yeah, just wanted to ask, given that the Tao Fund will co-invest with other funds, managed by 6th Street, could you address, the potential for conflict or adverse selection in terms of the investments that get put into Tao versus, the other funds?
Sure, great question. So first of all, and most importantly, Tao participates alongside the other funds. So if we make a debt investment and it goes into Tao and one of the strategy specific funds, Tao and the strategy fund will just pro rata own the same strip or the same type of security in the investments. So first of all, they'll own the same exact thing. So there will be no conflict in terms of one owning something different than the others. The way the allocation works is put kind of deals into generally two buckets across 6th Street. Transactions which don't fit the mandate or the strategy of any of our strategy specific funds. All of those deals go straight up to Tao. And so approximately 40 to 50% of the Tao portfolio are simply transactions that don't fit into any of our strategy specific funds. And then number two, when a transaction fits into a strategy specific fund, the way the allocation process works is that fund will go first up to a concentration limit. And then beyond that, Tao participates alongside that fund in the transaction. Now, for the avoidance of doubt and to color up something Keith said, approximately 60 to 80% of everything we do in our strategy funds are also in Tao. The reason for that is the denominators of the strategy funds are much, much smaller than Tao. So our strategy funds typically have a denominator between 1 to 3 billion in size. Tao is 25 billion in size. And so typically those smaller strategy funds are focused on smaller positions that are bite sizes of, let's say, 50, 100, or 150 million. Any transactions that are beyond the bite size or capabilities of just the strategy fund investing, Tao participates alongside, and that's the vast majority of the deals we do. Does that answer your question?
Yes, it does. Thanks very much for that. And Madam Chair, I'd also be remiss, I think we should just acknowledge, I think Martin Chavez, is a vice chairman and partner of 6th Street, and, he's really a New Mexico success story in the world of high finance, and it's just tremendous, his career, and we're very proud of his accomplishments. So I think we should acknowledge that.
Yeah, I appreciate you calling that out. As some of you may know or don't know, Marty is a very well-known guy. He was a computer scientist, PhD, I believe in the same class as Reed Hastings, who was one of the folks who revolutionized how trading works in the world effectively. At one point, basically creating the modern electronic trading floor at Goldman Sachs with over 9,000 computer engineers reporting into him. He eventually became the CFO of all of Goldman Sachs. And I guess about a year and a half ago, he joined us as partner and vice chairman. And so we're super excited to have Marty as one of our partners here at 6th Street. And as was just said, he is a born and raised New Mexican.
And a graduate of Albuquerque Academy.
That's right.
Great, thank you. Further questions?
It sounds like I should have Marty do the next presentation. I don't know why Keith asked me to do these when we could get Marty. I'm just kidding, by the way, Keith, but I'd be happy to have Marty come do one of these.
Do I have a motion?
Madam Chair, I think I just want to double check and make sure. Tim had indicated he wanted this moved up. Tim, do you have issues, and what are your questions? Did we lose? Have we lost Tim?
You've got one Tim on here. I don't know about Tim.
I apologize, Treasurer Eichenberg.
Maybe.
Madam Chair, I think he had indicated he had to catch a flight. I guess we must have missed him. With that, if there are no further issues on that particular idea, under 3D, based on the recommendation of the Council Investment Committee, Consultant Axia, SIC staff and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $250 million to TSSP TAO, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Kathy. I second that.
All right, great. We've got a proper motion from Member Lavender, a second from Member Allen. Any questions on, any committee discussion on that motion? Hearing none, we will have Andy call the roll.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg. I believe he's disconnected, but just to make sure. Secretary Romero.
Yes.
Mr. Rawson.
Yes.
Mr. Bingaman.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Lavender.
Sorry, yes.
Mr. Jennings.
Yes.
Madam Chair, the motion is unanimously approved.
Great, thank you so much, and thanks to the folks on with us from 6th Street.
Yeah, thank you, everybody. I really appreciate it. Bye-bye.
Madam Chair, moving back to you to run through the rest of this part of the agenda. I know we've normally done it that way. We have our second vote.
Right, so we are actually going to return to our agenda as written and published. So we'll go to the private equity investment recommendation, Bain Europe 6, and I'll turn it over to Mr. Lee and Mercer.
Commissioner, this is Steve. May I break in for just a moment?
Yes.
I know Brent is going to need to step off, so to speak, to step off the call for another call. And I'm wondering, Brent, if you want us to try to move your report up or just leave it as is.
Steve, as is fine.
Thank you, Commissioner.
All right. Mr. Lee.
Thank you, Madam Chair. This is David Lee, Private Equity Director. I'm joined on the call by Chris Cassidy, Private Equity Portfolio Manager, Richard Pugmire and Amy Ridge from Mercer, and Luca Babu, Managing Director of Bain Capital. I will try to provide a short summary of the materials, which start on page 66 of Diligent. Bain is one of the largest global private equity organizations with roughly 270 private equity professionals across 9 offices. And the European PE team consists of 65 investment professionals based in London and Munich and is led by 16 managing directors. The fund strategy will focus on mid-sized, large-sized buyout investments, either headquartered in Europe or having a European dimension. The fund will focus its sourcing efforts in 5 sectors: industrials, consumer, technology, financial and business services, and healthcare. Bain Europe 6 will have a target of 12 to 15 companies in the fund, and the investment check sizes will fall in the range of 200 million to 400 million euros each. The total size of the fund is 5 billion euros, which includes approximately 500 million euros of GP commitment. For comparison's sake, Europe 5 was 4.5 billion euros and Europe 3 was 3.5 billion. The GP commitment here is quite a bit larger than competitors and is consistent with Bain's historical alignment through sizable GP commitments. The depth
the investment and operating professionals. And on the operating side, the portfolio group has 67 professionals, 35 plus year investment history, and vertical sector expertise. Those are considered the biggest strengths of the Bain platform. The private, in terms of performance, the private market equivalent performance for the last 4 months, which encompasses almost 17 years, has been booming with sizable gains against both the MSCI Europe and MSCI World indices as of 9/30/2021. Relative performance versus the Burgess Europe buyout universe has been first or second quartile for funds 3 and 4, while funds 2 was impacted by poorly performing retail investments. And fund 5 has sorted slowly, but the average hold time for fund 5 is still less than 2 years. So a lot of time to go. Overall, Bain's investments for the last 4 funds have generated a 27% gross IRR and a 2.4 times gross multiple. Historically, Bain Capital funds have been very difficult to access, and staff and consultants believe that Bain continues to be an excellent long-term partner and are recommending a commitment of up to 25 million euros, which current exchange rates is about $26.8 million in Bain Capital Europe Fund 6. This would be the 4th commitment from the SIC to Bain Capital, including previous commitments to 50 million to Bain Tech Ops, 50 million to Bain 13, and 60 million to Bain Tech Ops 2. And at this point, I'm going to turn it over to Richard Pugmire of Mercer for further comments.
Thanks, David. And to build on that comment that David was just saying, the council's reviewed 2 different Bain private equity funds in the past, the Technology Opportunities Fund and the Main Private Equity Fund, which are both more North America focused. Neither are expected to have a lot of Europe exposure. And Bain really has a strong private equity platform across the globe. And adding this fund to the national program is a way to gain more exposure to Europe without adding a new manager to the roster. And as a reminder, we have a target of 10% to 25% to European investment in the national program. Focusing on the fund, we like the alignment that Bain has established between the manager and limited partners. The firm is showing its support for the European fund with a sizable commitment that is significantly larger than what a lot of funds have as their minimum commitment. The team managing the fund has a long history investing in Europe. There are 16 managing directors with an average tenure of 14 years at Bain, and the European team is over 65 investment professionals total. This team has access to the broader resources of Bain Capital, including experts in North America and Asia, which is important because many European companies also focus on opportunities in the global economy. The strategy is going to be focused on buyout investments across multiple sectors. Their strategy is focused on building strong companies and may include complex situations like corporate carve-outs, which actually may become more attractive in a volatile economic environment. Bain has a portfolio group that's actively involved in assisting portfolio companies with value creation initiatives. And this group includes 17 individuals in Europe alone and 67 individuals overall. From a track record front, our report points out performance has been mixed, but positive overall. Fund 3 and 4 are top quartile or above median, and Fund 5 is too early to be meaningful. Some of the companies in the 2 recent funds have been impacted by COVID-19 and supply chain disruptions, but this is where having a group that focuses on operational improvements is a positive, as they've helped many companies with cost analysis and cash management during the pandemic. When you look at realized companies that Bain has sold, the performance is strong overall. And another attribute that we like is with their track record is the ability to generate consistent performance across multiple geographies in Europe. You may have questions about investing in Europe with the current economic environment. When you look at how Bain has invested prior funds, it's been over multiple years, so you're not putting all the capital into Europe today, but it is expected to be deployed over the next few years. This allows Bain to continually evaluate the market opportunities in the region. They also focus on companies headquartered in Western Europe, which includes the UK, Italy, France, and Germany. And we're recommending a commitment of up to 25 million euros to Bain Capital Europe Fund 6.
With that, I want to introduce Luca Bassi, who's a managing director of Bain, located in the London office. He's been with the firm for 19 years, and we'll turn it over to them for their presentation, and then happy to take any questions the council may have.
Thank you. Good afternoon, everyone. I'm Luca Bassi. I've been with 19 years with Bain Capital. I'm an Italian national. I joined after having worked for Bain & Company, Goldman Sachs, and have been for over 20 years based in London. I think a lot of things have been already said in your introduction, but I would probably focus on first what is our sort of key highlights of our source of differentiation. And I think I talk about three things. The first, we have actually a large and experienced and deeply local team. So Europe is a complicated market. It's made up of many different geographies. It's very important to be very local and to be locally entrenched when we look at investment opportunities. And so we have both the deal team as well as the portfolio team has a lot of different geographies. We kind of speak all the languages in Europe. We typically staff deals combining vertical and industry expertise at the partner level with geographical knowledge and geographical relationship. I think the second important point is the strength and the importance and the differentiation of our global platform. And we work very well. We are a European fund, but we're actually part of a real global organization and also global and sizable multi-asset manager group. And so we develop our capabilities working a lot, not only with our North American and Asian team on the private equity side, but as well as our technology opportunity fund, with our life science fund, with our venture fund, as well as with our credit team that have a lot of relevant capabilities in a number of market niches. Alignment of interest. As you know, the people, employees of the capital are the largest investor in each and any of our funds. And that is true as part of our culture at all the levels of our organization, from the associate to the principal to the managing directors. Everyone of us has a significant portion of his own net wealth invested in our products. It's part of our philosophy, basically eating our own cooking. I'll talk a little bit more in detail about our team, our model, and the key sources of differentiation. Importantly, as I said, we have 65 people in Europe, but we also work very well as part of 270 professionals on the private equity globally. We look at our business, we manage our business through industry verticals, but we also are very focused on the importance of the local connectivity. Europe is not all the same. Doing a deal in Germany is different than doing a deal in France, it's different than doing a deal in the UK, and it's different to do a deal in Italy. We are very aligned. We're actually the largest investor in any of our fund. We're very focused on being a private partnership, and our focus is generating returns and not investing capital to generate a recurring fees. In terms of our model, what is important is we come from the root of the consulting of Bain & Company. So we're actually very focused on conducting deep in-house differentiated due diligence. Of course, we develop capabilities in the current market. Capabilities are paramount, and we develop them through our global footprint and having access to the pocket of expertise across our company, our group. We're very focused on building companies for the long-term success and having a lasting impact. We take incredibly seriously all the ESG topics. We are always focused on supporting our companies as well as our communities and our stakeholders with the objective of leaving our companies stronger when we sell them and when we exit our investments than when we bought them. Last point, what are the sort of key sources of our differentiation in the market? I think number one is clearly expertise and capabilities, both in terms of track record and seniority of the people working in the fund, as well as the global pockets of capabilities in the firm. We're always focused, we've always been around for a long time. Our private equity managing directors team has actually a long tenure at Bay Capital in Europe. For us, we've actually learned the hard way during the global financial crisis that the price discipline is paramount. And so we're very focused on how much we pay what we buy and how much we pay for the growth we get in the assets. And we think that will be a differentiating factor in a market that is changing and repositioning from a valuation perspective as has been happening in the last few months. The last important point, we always want to do something different with the portfolio companies that we have. So we always look for some degree of transformational change. And we are able to implement this transformational change through our expertise, our capabilities, our network, and the strength and depth of our portfolio team. Maybe I stop here and very happy to take any question.
I'm sorry, does that conclude your presentation?
Yeah.
Okay. We'll go to council questions of Mr. Lee, Mercer, or Bain. I'm sorry, who's the gentleman speaking from Bain, Mr. Bassi?
It's Luca Bassi. Luca.
Okay, thank you, sir. Any questions from council? Do we have a motion?
Madam Chair, this is Harold. Each of these investments was approved for recommendation to the council by the investment committee. Once again, Mike Messina couldn't be there, but John and Ulrich and Nick and I each have recommended approval. Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC Investments, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to 25 million euro in Bain Europe 6, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Catherine Allen. I second.
Okay, we've got a proper motion by member Lavender, a second by member Allen. Any discussion on the motion for 25 million euro investment into Bain Europe 6? We can have Andy call the roll, please.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Mr. Rawson.
Yes.
Mr. Bingaman.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Lavender.
Yes.
Mr. Jennings.
Yes.
Madam Chair, the motion is unanimously approved.
Very good. Thank you, and thank you to the representatives from Bain.
Thank you very much. Thank you.
Okay, next we'll move to our New Mexico Private Equity Investment Recommendation for Scout Ventures 4, and I'm going to turn it over to Mr. Cassidy and Mercer.
Good morning. We're presenting Scout Ventures 4 this morning. This is a name that a lot of you may recall. We brought Scout 3 Ventures in February 2021. And so this would be our second commitment to Scout Ventures. We're recommending a commitment up to $10 million for the New Mexico program. Staff believes that Scout continues to be a great fit for the New Mexico program. Scout is an early stage VC that targets the intersections of advanced frontier technology, dual use technologies that have both commercial and government applications and can be sold to both markets. And experienced, hard to access founders from existing premier research labs like Sandia and Los Alamos, the military, and the intelligence community. Most of Scout's professionals are either graduates of the military academies or served as officers in the military or involved in the intelligence community. Scout maintains a differentiated national network of relationships across national and private research labs, the intelligence community, and other government agencies like the CIA and NSA, military R&D labs like the Air Force Research Lab, and other national security innovation groups like Intel. Scouts remains active in New Mexico with a couple local companies, which I don't want to steal their thunder, speak about more detail, including one of which they incubated using technology out of Sandia Labs. I'll turn it over to Richard from Mercer to discuss the investment in a little more detail.
Thanks, Chris. Like Chris mentioned, Scout is a re-up in the New Mexico program, and we think it continues to be a strong fit for the purposes of the program. We did previously do a $5 million commitment to Scout Ventures Fund 3 in 2021, but it's important to note that the SIC came in at the tail end of their fundraise, which is why it seems like we're talking about it sooner than what you may expect. Fund 3 actually started investing in 2017, so they did invest that fund over multiple years. Just starting with the New Mexico activity, which is an important part of the analysis that we do for any fund in the New Mexico program, Scout has invested in 2 companies in Fund 3 after reviewing more than 30 opportunities. And one company Scout led around that raised $7 million. They also helped form a company that's based in New Mexico. And one of the things when we presented Scout last year, we talked about was their ability to attract non-dilutive financing for their portfolio companies. And they've actually been able to do that for their New Mexico investments, which is a great added benefit that we've seen. And they continue to be active in the ecosystem and interact with both the national labs and participate in local events. From an investment perspective, we think Scout has a strong team with a variety of experience, including investment experience, but also the U.S. military experience that Chris was talking about, which has helped them establish strong relationships with different government labs and intelligence agencies. And they've also built a strong group of venture partners to assist across the investment process. The team's built a strong sourcing mechanism using a lot of local contacts like they have done in New Mexico. And they've also established contacts at organizations across the country. From a track record perspective, previous funds have been performing well, particularly Fund 2. They do have several investments with over a 10 times valuation, which is what we'd like to see for a seed-stage strategy like this. The caveat being that it is largely unrealized at this stage and ultimate outcomes can be volatile. There have been some transitions on the team, with 2 team members transitioning to venture partners. But Brad Harrison has been the central figure at Scout since the beginning, and there's a key person provision that would trigger if he were to depart. But he's been able to recruit a strong team to support Scout's activities, including partners Wes Blackwell and Sam Ellis, who also both have U.S. military experience. And they were also able to recruit Ryan McCarthy, who's the former Secretary of the U.S. Army, to the firm as a venture partner, which has really opened up their networks as well. Their strategy of focusing on seed or even pre-seed companies tends to have longer hold periods, so it could take a while for performance to develop in these funds. There's also a high level of losses that are expected in seed strategies, but they've designed their strategy to invest in companies over time in order to support those companies that are meeting the milestones and are emerging as successful, which helps mitigate that risk. So given our analysis on Scout Ventures Fund 4, we're recommending a $10 million commitment to be included in the New Mexico program. With that, I'd like to introduce Brad Harrison, who's the founder and managing partner at Scout, and Wes Blackwell, who's a partner at Scout, for their presentation. And then we're happy to answer any questions that the council has.
Thanks, Richard. Good morning, Madam Chair and members. My name is Brad Harrison. I'm the founder and managing partner of Scout Ventures. I wanted to first thank you all for your time today and the opportunity to share what we're doing at Scout and in New Mexico. It's great to be back with you in 2022. For those of you that were not present at our last presentation, Scout Ventures is a seed stage venture capital firm focused on investing in founders from the military, intelligence community, and premier national labs and research institutions, which New Mexico clearly has plenty of. Our team consists of military service academy graduates who spend years in active service as operators and as entrepreneurs, founding companies at the forefront of innovation in both government and civilian worlds. Character, integrity, and diversity are woven deep into the fabric of our culture, inherently reducing reputational risk to our LPs. We are headquartered in Austin, Texas, with offices in New York and Washington, D.C. Our geographic distribution is deliberate in nature and part of a larger effort to be closer to both underserved and high potential technology markets where there is talent to match, New Mexico being a prime example. To date, Scout has invested in 100 companies with 23 exits and counting, and 3 unicorns at the seed stage, ID.me, Voyager Space, and Unite Us, which we incubated out of our Scout office, all 3 of which I proudly add are founded by military veterans. Over the life of the firm, we came to realize that our best performing deals had a variety of traits, but at its core, they were founded by entrepreneurs that we now call hard to access. As I mentioned earlier, these are the founders that are veterans of the military, intelligence community, and preeminent research institutions and national labs like Los Alamos and Sandia. With that in mind, you can see why we continue to strongly believe that New Mexico is a natural partner for us as we double down on our strategy. We believe that we are uniquely positioned to help New Mexico-based companies succeed. To execute on our strategy, Scout has assembled a team with truly unique backgrounds in the venture ecosystem. First, I'm a distinguished undergraduate of West Point, after which I served as an airborne ranger. After the military, I went to MIT Sloan, where I focused on new product and venture development, fueling my passion about technology, venture capital, and entrepreneurship. Following MIT, I had multiple operator roles, helping scale 2 startups, and I also worked directly for Ted Leonsis, the vice chairman of AOL. Throughout these experiences, I was an angel investor, which led me to founding Scout in 2011. Further, my business partner, Wes Blackwell, who is also on the call, has a similar background. He has led small elite teams and has also been key to scaling several companies. He is a Naval Academy graduate, flew naval helicopters for over a decade, doing counter-piracy as well as combat search and rescue. He finished active duty time doing admissions and teaching leadership at the U.S. Naval Academy. This was followed by stints in private equity and hypergrowth startups. This led him to angel investing in founders coming out of the military intelligence community and research communities, which is how we met. Sam, our third partner, and also a West Point graduate, formerly served as a military intelligence officer at U.S. Cyber Command. He followed this up by being an early employee and technical co-founder of multiple successful tech companies, including a unicorn he co-founded. He is also an experienced investor, having founded a fund that invests in West Point graduates building SaaS companies, which is how we met. He brings technical expertise in-house that helps us diligence deals as well as recruit technical talent for our portfolio. The rest of our team is equally impressive. It includes the most recent Secretary of the Army, Ryan McCarthy, as a venture partner and special advisor. We have other military veterans, former intelligence officers, and team members with finance, fund admin,
and investment banking experience. I'm proud to say this is the most talented and complete team I've ever assembled at Scout. We've also recently taken a leadership role in leveraging and organizing our networks that we've informally belonged to over the years. First, we helped launch and fund a platform that leverages the talent pool of military service academy graduates to identify, syndicate, invest, and support veteran-led companies, called the Service Academy Investor Network. Second, we invested in a vertically integrated operating company that invests in the space sector called Voyager Space. Scout's thesis targets the intersection of advanced frontier technology with dual-use applications, meaning most of our current fund companies have government and commercial applications built by the aforementioned hard access founders. We continue to believe that the New Mexico ecosystem is key to us executing the strategy. The high density of PhDs, research, university, and military labs is ideal for Scout. As such, I think it would be helpful to let you know what it looks like in practice as we further embed in the local ecosystem. In 2020, prior to the pandemic, we were in New Mexico on the ground almost monthly. Now that's slowed down a little bit, unfortunately. However, we have weekly, if not daily, contact with stakeholders in New Mexico. In the last year, the Scout team has continued to do investments in New Mexico companies, most recently Sandia National Labs spin-out Chipolytics. We've also attended multiple board meetings, served as a panelist in person at local pitch competitions, most recently the Unique Taos Ski Lift competition, sourced new potential deals, mentored and assisted multiple companies, and established a regular cadence of engaging with local investors, universities, and various research labs located in New Mexico. We recently even hosted a half a dozen Los Alamos postdocs in our DC office this month, helping them think through their commercialization of their respective technologies. Scout has recently led multiple deals in New Mexico and is in diligence with multiple other New Mexico-based companies. Our investment in Los Alamos-based Ubiquity, a material science company that manufactures stable and non-toxic quantum dots designed for agriculture, security, and solar power application, remains one of our largest positions in the current fund. We continue to actively participate in the company's growth, attend board meetings, hold regular check-ins with the CEO, introduce the company to other potential investors, and refer job candidates to build the team. We recently invested an additional $375,000, which helped them secure a one-to-one match and a NASA grant. Additionally, we wrote a letter of support to secure a $750,000 Air Force Phase 2 SBIR grant. That's the non-dilutive funding that Richard Pugmire referred to. Ubiquity also began raising a Series B priced equity round late in Q1. Scout has made key introductions to several potential notable lead investors. In total, we've led the investment of over $8 million into the company. We are encouraged by the continued progress Hunter McDaniel and the rest of the team is making. 2021 revenue increased almost 200% over 2020, and they made positive gains in every category. We are also pleased to say that Ubiquity has 26 high-quality, full-time New Mexico-based jobs, and that number continues to grow rapidly. Ultimately, we look forward to replicating their success with other New Mexico-based startups as we continue to explore new investments in the state. Another example of this recent investment in an Albuquerque-based company, Chipolytics. They're a talented team built around a technology licensed and spun out of Sandia National Labs. As I'm sure everyone here has seen the ongoing problem in the reliability and security of the semiconductor supply chain, Chipolytics is building the first semiconductor inspection platform that combines machine learning and electrical testing to enable rapid data-driven quality assurance. They have 3 employees with plans to hire in partnership with the electrical engineering department at University of New Mexico and build their first lab in New Mexico. They have office space in the Air Force Research Lab sponsored facility called Q Station, which is located in Albuquerque. We're very bullish on this team and their timely technology and excited to watch their future unfold. Also, we're establishing a regular cadence to engage with various stakeholders in the New Mexico technology ecosystem. This includes Los Alamos National Labs, where Ubiquity was started, Sandia National Lab, where Chipalytics was started, the Air Force Research Lab, Army Applications Lab, NASA, University of New Mexico Angels, Iron Creek, Sun Mountain, amongst others. This activity has led us to evaluating over 24 New Mexico-based investments in the past 12 months, resulting in the investments in the Ubiquity and Chipalytics. We have joined the New Space Alliance of New Mexico and the Space Valley Investor Networks, which help grow and support the space industry in New Mexico. We also have reoccurring calls and meetings with various research institutions such as Los Alamos, UNM, and AFRL, where we assist them by mentoring, sharing our network, and ultimately helping them commercialize their technologies. We are extremely excited about this opportunity to collaborate further in New Mexico. I'm happy to answer any questions you may have. Thank you for your time this morning.
Thank you so much, Mr. Harrison. And I just want to mention, I'm very glad that you noted the example and success of Ubiquity as a spin-off technology from the laboratory for quantum solar dots. If folks want further information, they were actually just profiled by the Albuquerque Journal in Saturday's edition. And there are, in fact, windows at the Holiday Inn in Los Alamos that have the quantum dots, solar energy panel dots on the hotel windows. If folks are curious about what that is, it's a pretty advanced technology for solar generation of energy. So I'm always excited to see our investments in New Mexico companies. I wish this recommendation was higher. I understand that it is right-sized for our allocation, but I wanted to put that out there. So with that, we're going to go to questions from council for either Scout Ventures, our folks, or Mercer. Any questions from council? Do we have a motion?
Once again, Madam Chair, the investment committee recommends this approval by the council. Based on the recommendation of the council investment committee, consultant Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $10 million to Scout Ventures 4, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Catherine Allen. I'll second this. Also, I am going to have to get off the phone now, and I do approve of all of the other investments. I don't know if you need that vote or not, but anyway, I'm going to need to get off.
Thank you, Member Allen. So we've got a proper motion by Member Lavender, second by Member Allen. Was there someone else that wanted to speak? Do we have discussion on the motion? All right, let's have a roll call vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Mr. Rawson.
Yes, I had it on mute, I'm sorry.
Mr. Bingaman.
Yes.
Mr. Messina.
Hold on.
Yes.
Mr. Tejas.
Yes. Yeah, just a minute.
Ms. Allen has left the call.
Yes.
Mr. Lavender?
Oh, there she
Ms.
is.
Allen, yes?
Yeah.
Great, thank you.
All right. Bye, you all. Sorry, I have to leave.
Thank you.
Okay.
Mr. Lavender?
Yes.
Mr. Jennings?
Yes.
Madam Chair, the motion is unanimously approved.
Excellent. These are the kind of investments that I am on the call for. So thank you so much. Thank you to Mr. Harrison for being with us. I'm very excited about this investment. Yep. Okay.
Great. I appreciate your time.
All right. So as you all know, we have already voted on agenda item 3D. So we're going to now agenda item 3E, non-core fixed income 400 capital ABTF, and we'll go to Mr. Sable and Axia.
Thank you, Madam Chair. The materials for this portion of the presentation begin on page 285 of your diligence board books. New Mexico staff in consultation with Axia are recommending a commitment of up to $75 million to 400 Capital's asset-backed term fund. The fund targets net returns in the neighborhood of 12 to 15%. New York-based 400 Capital is a modestly sized investment firm with approximately $5 billion in AUM as of May of last year. The group was founded by Chris Henton, whom you'll hear from shortly. He and the partner group own 100% of the GP, and we think that's great for alignment of our interests. 400 Capital has developed deep expertise in evaluating loan performance and collateral value across housing and consumer-facing credit sectors, and is skilled at sourcing and structuring deals in the private markets. Patient capital and the firm's relatively small scale have enabled it to source and structure deals in pockets of the markets with relatively less competition, and because of that, to extract a liquidity premium. Key focus areas for opportunities for the general partner are clustered into 4 key groups. That's U.S. Bank and GSE deleveraging and risk transfer, European Bank deleveraging and risk transfer, specialty finance, and market dislocations. We found that a significant portion of the prior vintage performance, which dramatically outperformed its stated target, was driven by the GB's ability to have patient capital with which to exploit disruptions in the public structured credit markets that were attributable to COVID. The public markets are not a principal focus of the fund and are expected to represent a small portion of the current vintage investments. Still, the GP retains the flexibility to exploit future potential disruptions in the public structured credit market. And as a result of these public market investments, exposing the portfolio to incrementally more mark-to-market risk, we've determined that we should seek an allocation about 1/2 of our standard private allocation, and hence the $75 million request. In March of last year, Council approved the wind down of a legacy separate account in the structured credit pool. We believe an allocation to 400 Capital would replace some of that exposure and move that portion of the book closer to its long-term target allocation. For all of these reasons, we're recommending an allocation of up to $75 million be approved. With that, I'll hand the floor over to Axia and Trevor for their underwriting.
Keith, thank you. I'll keep my comments brief. We talked about Sixth Street earlier as being very diversified. This one fits squarely in the structured credit category, and it's really a focused asset-based strategy that offers nice diversification, as Keith mentioned. It's just something very different, and we've kind of recommended an allocation appropriately at $75 million. The strategy also provides significant European exposure, an area that helps the non-core fixed income portfolio continues to diversify geographically outside of the U.S. So if we sit back and look at the portfolio, we want to have diversifiers in many different areas, and this fits nicely within that. I'm going to turn it over to Ilya, who will focus on the IDD of the strategy, and we have Caitlin available for ODD questions as needed. Ilya?
Yes, hello, this is Ilya Viston from Axia. Happy to be on with everyone today. Like Trevor, I'll keep my comments short. This is the second iteration of us reviewing the ABTF strategy, with us having rated ABTF 2 as well. Generally, we tend to think very highly of the team. Kind of came up by way of B of A, led by Chris, and some that tends to be sort of the pedigree of a lot of the senior staff. Similarly, a number of staff have worked at housing agencies, namely Freddie Mac, which we think confers a real kind of informational advantage vis-a-vis some of the legacy portfolios. And we tend to lean on the managers, kind of the housing, the housing expert, U.S. housing expert, and their and their commercial investments tend to have multifamily character. really, again, leveraging that U.S. housing expertise. To kind of piggyback on Keith's point and Trevor's around flexibility, we really think this is an interesting way to sort of retain flexibility to take advantage of dislocations in the private markets, in the public markets, while systematically kind of putting money to work on the private side, particularly the land banking strategy, which I'm sure Chris can speak to at length. We think is a real differentiator, and it is something special that not a lot of people are doing in that kind of second-tier home builder category, if you will. So I can stop there and come back if there's any questions.
Okay, great, Elliot. Thank you. Chris.
Thank you. Thank you, Keith, Madam Chair, and the council. I'd also like to thank the investment team at SIC and AXIA for all the hard work that they've committed to the due diligence for our fund today over the past 3 months. I am Chris Henneman. As introduced, I'm the founder and the CIO of 400 Capital. As for our formal presentation, 400 Capital is an alternative credit manager serving institutional investors with a little over $5.8 billion under management today, and a team of 63 full-time professionals located in New York and in London. Many of my fellow partners and colleagues have worked together as far back as the early 90s and had experience navigating market cycles and developing businesses for decades. The average working experience of each of our partners is over 20 years, and the investment team has over 15 years of average investment experience. I always like to comment that we've learned to make decisions amongst ourselves. We're not making decisions on our investors' dime. Over the past 13 years at 400 Capital, we have focused on building investor partnerships serving the long-term and capital preservation objectives for institutional investors like New Mexico SIC. Approximately 60% of our firm's current assets are those of pension plans. Since day one, our philosophy has been to leverage the depth and experience of the team to source unique, idiosyncratic investments that have asymmetrically favorable return characteristics with cash flow and asset-based downside protection that meet the objectives of our institutional client base. Today, we are presenting an investment in our third private credit vehicle, the Asset-Based Term Fund 3. Our strategy primarily targets fundamentally driven, theme-based, asset-backed credit opportunities, mostly vacated by financial institutions due to post-GFC regulatory requirements across residential real estate, commercial real estate, consumer finance, and specialty marketing.
Can I remind everybody, please, to mute yourself if you're not speaking? I'm sorry for the interruption.
Oh, no.
Please let me know if I need to repeat anything. I'll proceed for the sake of time. We launched the Asset-Based Term Fund series in August of 2017. The first two funds in the series, ABTF 1 and ABTF 2, have performed well, returning 17 and 26% net respectively as of the end of the first quarter, against a targeted return, as mentioned, of 12 to 15% net. And with
I'm sorry, Mr. Henneman, just 1 second. That actually sounds like Brent.
I'll put an order in to get an MRI scan.
I just texted him, Madam Chair.
First, and then they'll schedule it and contact you, and I guess we'll get together again.
Yeah, we don't have any
ways to thank you so much.
Ourselves.
Okay, sir. Any questions?
That's it.
All right, you take care.
Madam Chair, I think it sounds like the mayor.
Yes.
Are you muted, sir?
I'm not right now. I was. I thought I was.
Thanks. Mr. Henneman, would you proceed, please?
Thank you. We launched the Asset-Based Term Fund series in August of 2017. The first two funds in the series, Fund 1 and Fund 2, have performed well, as noted, returning 17 and 26% net, respectively, as of the end of the first quarter of this year,
against a targeted return of 12 to 15% and money multiples that we're targeting of 1.5 to 2 times. ABTF3 targets a net return of 12.5 to 15% as well with similar multiples. We believe that our broad-based connectivity to the structured finance markets, plus our experience developing financial solutions, rigorous underwriting, proprietary analytics, and rigorous risk management give the fund the ability to meet these returns. Additionally, the fund has the ability to pivot into dislocated secondary markets for loans and securities should the conditions warrant. This flexibility helped enhance the performance of Fund 1 and 2 and kept the fund active in volatile markets. I would like to note that net of the dislocated opportunities, the funds were still able to meet original underwriting expectations in Fund 1 and Fund 2. Relative to the size of the fund, the broad asset-based finance markets estimated to be over $15 trillion, and the fund's ability to rotate among opportunities using the firm's entire investment team is a key attribute in selecting investments that meet our objectives without being forced to deploy into unattractive opportunities. To date, we have deployed over $100 million of currently committed capital to ABTF3 into an increasingly attractive market opportunity, and we remain excited about the additional opportunities remaining in the pipeline. Thanks again for allowing me the opportunity to present our firm and our fund to the council today. I will now open it up for questions.
Thank you so much, Mr. Henneman, and thank you for your patience with our process here telephonically. All right. Do we have questions from council members on this investment recommendation? Questions from council? All right, do we have a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, consultant Axia, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to 400 Capital ABTF, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork. Second, Nick.
All right, we've got a proper motion by Member Lavender, a second by Member Tejas. Welcome, Member Tejas. And do we have any discussion on the motion? Hearing none, let's have a roll call vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Mr. Rawson.
Yes.
Mr. Bingaman.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Mr. Lavender.
Yes.
Mr. Jennings.
Yes.
Madam Chair, the motion is unanimously approved.
Thank you very much. We have approval of the investment into 400 Capital ABTF, and we thank the folks from members of that firm for being on today.
Thank you.
All right. With that, we move to recommendation from SIC staff on investment decision-making, and we do have 2 items that we're going to consider today. I think I'm going to turn it over now to Mr. Smith. Is that correct?
Thanks, Madam Chair. That's correct.
And I had a request if we could take, I don't know if folks want to take both recommendations separately or as one. But why don't we hear from you first, Vince, on what the recommendations are?
Okay, you bet. So just a few comments for me, and I'll turn to Chair Lavender after that. So we brought this to the investment committee. I think it was back in February at their Fed meeting for 2 actions. One, to discontinue manager presentations at the council meetings, and a second to discontinue requiring council approvals for re-ups or follow-on investments. And there's a memo in your book to kind of define all that and talk about those things. The committee accepted those recommendations and brought them forward to the council. The council didn't like the first recommendation, or didn't accept the first recommendation to discontinue the manager presentations, but and wanted some further work on the discontinuing approvals for re-ups. So we've gone back and done that additional work, and I think what the council was looking for was maybe some more controls around sizing of the investments. So at a certain size, we would bring it to the council. Otherwise, we would do it internally. I just really didn't find anything there that seemed to fit well with the idea of discontinuing the approvals or re-ups. Putting a cap on it puts some weird decision making into the process. So in other words, if we put, say, $150 million cap, it kind of puts our asset class directors in a position of, if I do less than 150, we can prove it internally. If I do 150 or more, then I've got to take it to the council. It puts that kind of decision making into the process, which we really try to avoid those types of decisions around the investments. So I think the recommendation, still just basically stands for action number 2 of the memo, that the council discontinue requiring approvals on the re-ups. If that's not something you're comfortable with, then rather than try to modify it with a cap or something, we'd rather just abandon the recommendation. So that's just a little bit of the background and where we still stand. But let me turn over to Chairman Lavender for any comments that he has.
Thanks, Vince. I think the committee, we had a lot of discussion about this, and we know that there's going to be discussion at the board level. One suggestion that was made was that if we're going to do this, that we try it on a trial basis, say for the next year, take a 1-year look at it, and let the process work the way it's described, and see how the council feels about that part of the process. It's very clear that the re-ups would be reported completely to the council afterwards. We would get the information and have the similar presentation to what we see now. The committee was comfortable with that aspect of doing it on a 1-year trial basis to simply see how it works. So that would be the nature of this particular approval, would be to approve this process for a 1-year trial basis.
Could I just ask for clarification before we go to council questions on these 2 recommendations? What about the investment committee presentation? So are the follow-on re-ups going to be presented to the committee or no?
Yeah, our idea was that these would just be approved internally. We'll certainly report to the committee, but the presentations wouldn't be done as now.
Madam Chair, that was another potential solution or suggestion, was that the presentation be made at the investment committee level. But I think at this point, the idea would be that we would put this in place on a trial basis for a year to see if the council, in fact, is comfortable with that. I think that that's where we stood at the last we reviewed it. Also, the first suggestion was taken off the table. That was actually taken off the agenda, and we're only talking now about the second part. The council was not comfortable with removing the manager presentations from the council, and that's actually not part of this vote. This is simply covering the idea of the re-ups.
All right, is that clear to everyone? So our material, starting on diligent page 351, outline these recommendations, but in fact, action 1, discontinue managers' presentations at council meetings, has been removed for consideration. So we're only dealing with action number 2, discontinuing requiring council approvals of re-ups and follow-on investments. Questions from council on this recommendation?
Madam Chair, Secretary Romero.
Madam Secretary.
So it's not necessarily a question, but just more of a comment. And I always worry about transparency and making sure that we have enough information so that, the public understands how and why we make our decisions. And so now that action item number 1 has been taken off, is not being considered, I think that with action item 2, as long as we have some reporting mechanisms and follow-up mechanisms, I think that that's a good compromise. Thank you.
Thank you, Madam Secretary. Further questions or comments from the council?
This is Lee.
Member Rawson.
I'm a little guarded, and this is not meant to speak towards the current staff, but we have a policy which, if we adapt this and say, even if it's for a year, but we renew it, down the road we will have eventually different staff. But it seems that this type of policy could result in staff pursuing the easiest choice versus a new and a better option. And I'd be a little guarded about staff potential. And I do not have that concern with the present staff whatsoever. I was curious if, given the duration of some of these re-ups, or the primary one and the re-ups, typically 10 to 12 years, and then every 3 to 7, maybe they come out with a different or a new opportunity. If there shouldn't be some limitations in relationship to the duration from the initial investment, or maybe some limitation in terms of the amount in relationship to the original investment. I mean, if the original investment was $100 million and the re-up is less than $100 million, that's different than if the re-up is $200 million. It seems there should be, and I know that the brief discussion earlier about limitations that staff really, it confines them, but it seems to me if given a particular investment, if we were limiting subsequent transactions to maybe a certain number of subsequent or over a period of X years, maybe at the most, or not to exceed a given amount cumulatively, because we could, you could stack a couple re-ups real close together and you're far over maybe the original investment. Maybe some language regarding only if the original investment was unanimous by the board or by the council itself. Or are we concerned if we have a change in our consultant, that whoever the consultant was for that is no longer with or consulting with the SIC, and we have a new consultant? Do we want to continue this program? So I just have a lot of different concerns about how it was structured. I mean, in general, probably pretty supportive, but I'd want to box it in a little bit. And just a few comments. I don't know if Vince or others would like to respond.
Yeah, this is Vince, Madam Chair, and thanks, Member Rawson. I appreciate those comments. I mean, and we really thought through or tried to think through, all those types of contingencies. I think we finally just came down to if the council isn't comfortable, not approving the re-ups, without some of the conditions like you were talking about, then we'd rather abandon the recommendation. If you're not fully comfortable with it, rather than trying to put on some of these limitations, we'd rather just not do it. It's kind of where we came down after a good bit of discussion.
Well, I took a little bit of time just to run the overall concern on this whole issue for actions 1 and 2. So I went back and for the last 3 years, I ran a total of how many votes the council has taken each meeting regarding actual investments. And in 2019, for the last 3 years, we've averaged 3.7 investment votes. at each meeting. Now, granted, January this year we had 9, which was by far the largest. So, but in general, 3.7, 4, maybe even 5, I don't think that's a huge burden for anybody. I do think when you get to 9, that gets to be problematic. So maybe there's some spacing issues, but I would prefer to leave it at the council level, given I just would prefer that at this point. Thank you, Madam Chair.
Thank you, Member Rawson. Further comments, questions from council?
Madam Chair.
I'm sorry, go ahead, John.
Yeah, I was just going to echo Secretary Romero's remarks. I would be supportive of this, and I would be supportive of it, particularly if we could put that 1-year reevaluation provision in there, to just sort of come back and reapprove this in a year and take a look at how this has gone. So I would be willing to make that motion, just including that concept in there.
Madam Chair, I was just going to ask Nick if he would, Nick was part of the discussions. I'm sorry, I spoke.
Madam Chair, I just wanted to ask Vince, does this help with expedite? I know we've had, some challenges with deploying capital. Would this help with making things more efficient? That's kind of what I'm assuming it would, but I would just like to hear your thoughts on that.
Yeah, thanks, Madam Chair, and Member Taylor. No, I don't think it wouldn't have any characteristics like that. What it mainly does is reduce the burden on the council in terms of materials and time and presentations at your meeting and so forth, and just sort of balances a little bit better the decision making process, at least in our mind. So you all interview the manager and see the strategy and approve it. We're just continuing that strategy with these re-ups is essentially what's happening. So I don't think there's not any expedite from us doing it internally. It's just really relieving some of the burden and some of the redo that you guys, you look at these managers every single time. We can reduce that to once, with this.
Yeah, and so Madam Chair, I'm supportive as well with taking a year to test this and and coming back a year from now to reevaluate and see how it's working. I think that is definitely doable. And so I had another question, but it's kind of left me right now. Let's see here. Yeah, I would just like to see the performance on the re-up, how that's happening. And the other comment that I had was to the concern that we don't really have, or we would need to have some sort of like parameters around amount and things like that. To me, the parameter really is the policy, the investment policy that the board has with respect to allocation of assets, right? So whatever percentage the board says and the council says on what we're going to do with private equity, that's kind of the control from my perspective that we would have. And I'd just like to hear the others' thoughts on that. Am I thinking about it correctly there, Vince?
Yeah, the investment policy has extensive, or has some very good controls around exposure to individual managers, exposure to particular types of strategies. Also, we bring you the structure studies for each of the asset classes, so you have some further control around, subsectors and things within the asset classes. So there's already a pretty strong, system of controls within your policy that you set.
Okay, thank you. That's all I have.
Thank you, Member Chaos. Further questions and or comments from the council on this recommendation?
Just clarification for Lee.
Member Ruffin.
As proposed, my understanding that the re-up could exceed the original investment. And we could make original investment in 1 year and have a re-up, so to speak, each of the next 3 years that would exceed individually the original investment. Is that true?
That's right. That's right. And we would expect that as the portfolio grows, that our pacing models will go up and our bite sizes, so to speak, or our investment per, or amount that we invest per investment would grow. So yeah, that would be an expectation you should hold if you approve this.
And that would hold true for the New Mexico equity, would it not?
We think, that program's about as big as it can get. We're up against the statutory size, and the severance tax fund doesn't grow as land grant does. So that the Mexico program in terms of size will be a little slower growing than, say, investments that we put into land grant.
Okay, thank you, Vince. I mean, I can support a trial, but not without some limitations, whether it's regard to the size or the frequency. But, okay, thank you.
I'm sorry, one more comment back on the New Mexico program. We will continue to bring all of those, so we won't approve any re-ups internally for the New Mexico program. After discussing a lot with Chris and Dave, they still want to bring all those to the council for approval, and I understand the reasons. So then for the New Mexico program only and specifically, you'll still see all those even re-ups.
Yeah, I would note that the problems the council has had historically before most of us was the direct investment by the council in really private equity. So opting out in New Mexico, I think if that gets part of the motion, that does make it a little bit better.
Are you finished, Member Rossen?
Yes, I'm finished.
So, I for my own part here, I do understand the tension that sort of exists within the council's authority as a body and the SIC expert investment staff as to who really makes the investment, quote unquote, makes the investment. And I'm still certainly learning about that tension and who really has what authority and jurisdiction in the investment decision making. But I just have to say that I will never be comfortable taking a vote that, results in what could be perceived as less transparency. And I have a lot of discomfort with this public body not at least seeing these re-ups before they're determined, especially given the size of some of these investment recommendations. So I just want to let everyone know I'm going to be voting against this motion. Is there anything further from the council before we take the motion? Member Lavender, did you want to make that motion? Is there any other member that would like to make the motion? Do we have a motion on the table?
move we go to the next agenda item.
Second.
So, Madam Chair, I think we have to, because it's identified as an action item, I think we have to take some kind of action. So at this point, I'll move that we just table this item.
I'll second that motion.
All right, so we have a motion and a second to table agenda item 3F, the vote on investment decision-making.
Madam Chair, if I may, again, and so I guess in addition to moving to table this, I think one of the things that we might be able to, I think it needs more discussion. I think that there were a lot of concerns that were raised today that need to be addressed. But I also think that we have other opportunities. I know again, I'm going to go back to State Board of Finance, that we have a consensus agenda. And maybe, and with that consensus agenda, all the members are briefed ahead of time of what these items are, and then they're put on consensus, and then we vote on all the things on consensus. So maybe that's another way to ensure that we're limiting, the amount of time that we're taking on these activities, but we're still informed, and we still, as the council, take action on them in a public meeting.
Okay, so we have a motion to table agenda item 3F. And so do we need to take a roll call vote on that?
Madam Chair, I believe we do. Motion to table, there's no discussion, and it's a voting item.
Okay, so let's have Andy take the roll on a tabling motion on agenda item 3F.
Commissioner Garcia Richard.
Yes to table.
Secretary Romero.
Yes.
Mr. Rawson.
Yes.
Mr. Bingaman.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Mr. Lavender.
Yes.
Mr. Jennings.
Yes.
Madam Chair, that motion is unanimously approved.
All right. Thank you for that discussion. So with that, we'll move on.
Madam Chair, if I could just interject that I think that the Secretary's suggestion is a good one. And I would like to suggest that we, at the investment committee level, that we have a meeting, that we have an issue that we can discuss about the possibility of a portion of the agenda being a consent agenda and that could possibly be a way that we could cut down on what needs to be done at the council meetings. But at the same time, it would be very transparent, and any member could bring anything forward. So I'm going to ask that we open that up for discussion at the investment committee.
All right, great. And you are the chair, so you control that agenda. I will let you handle that. Okay. With that, we're going to agenda item 3G, black dot chart, and we will start with Mikhail.
Thank you, Madam Chair, and good morning, everyone. I will be referring to diligent pages 353 and 362 in my presentation. First, let me briefly walk you through the underlying data. As was the case last year, our peer group consists of 36 organizations. Most of those are public pension plans, but it also includes some sovereign wealth funds and takes into account all 3 New Mexico state agencies. The data was extracted from comprehensive annual financial reports and includes assets under management, funded ratio, actual and expected rate of return, and each fund's target allocation. All the data points are as of June 30th, 2021. With that, let's now take a look at page 355. One small change we made this year was to base the analysis on each fund's target allocation instead of actual allocation, as was the case last year. For the sake of meaningful comparison, the table represents the average change of the actual allocation of the peer group over 1 year. Two observations here. Number one, the biggest positive change can be seen in allocations to private equity and U.S. equity, which are two highest yielding asset classes. And that is pretty consistent with the rising equity environment that has been observed in analyzed time frame. And number two, the largest drop is observed in allocation to the core fixed income asset class. That was also the only asset class with a negative rate of return over 1 year. Overall, no big surprises here as CIOs either stay put and stuck to their long-term targets or try to take advantage of the equity markets rally that was taking place. The next two pages represent an efficient frontier analysis for arithmetic and geometric returns. For our purposes, let's concentrate on geometric returns on page 357. Let me walk you through this chart first. So the green line is SIC's efficient frontier. Orange line is the so-called in statistics, the line of best fit, that essentially is a regression line that best expresses the relationship between points on this scatter plot. The yellow square is a hypothetical 70-30 portfolio. Green circle in the upper right corner is the SIC's position. And the orange circle on the orange line is your average risk, average return fund. Outside of one outlier, the vast majority of organizations fall in this 10 to 12% risk and 5 to 6.25% return box. That is also called the main cluster of observation. Here, I would like to note one thing. We compare ourselves mostly to public pension plans who have a completely different liability profile than a sovereign wealth fund. In general, and from historical perspective, sovereign wealth funds are a little more flexible in terms of how much risk they can take and what asset classes they can invest in. Risk in this case is measured by standard deviation of historical returns. And from this perspective, the riskiest asset classes are public equities, private equity, real assets, and real estate. As you are all well aware, 75% of the land grant permanent fund is allocated towards those asset classes, and that explains our position on the horizontal or risk axis to the right of this main cluster. But we are at the same time being well compensated for the amount of risk that we take, with 6.13% being the highest expected geometric return observed among all peers. On a risk-adjusted return basis, we are right in the middle of the pack with approximately 0.56% return per the unit of risk taken. And with that, let me pass it on to Matthias, who will further slice the peer group target allocations and discuss SIC's positioning from the allocation perspective.
Thank you, Mal, for the great overview here. I'll just pause, see if there's any questions on the slides that Mal has already covered. And if not, I'll proceed to the next four or so slides that, as was mentioned, really highlight the asset allocation across those 36 peer funds and how land grant is allocated in comparison. I would just add that these peer funds are all essentially the premier funds that we all know in the country that reflect similar level of assets and are most applicable peers in terms of their scale, resources, and investment expertise and acumen. So they are very comparable in terms of being able to select from a similar pool of potential investments. As Mahal mentioned, these funds are, though, primarily public pension funds. All of the sovereign wealth funds that do have a major program in the country are included, but it's a small handful, and you all talk to them on a regular basis as well. And so there's some familiarity there, but we don't have the explicit liabilities that many of these funds have, and for that reason, you're able to be a bit more flexible in terms of how you pursue your investment strategy, and that provides you with the opportunity to seek potentially higher risk-adjusted returns. So how does that play into the overall exposure differences? You can see that on page 358 at a high level, and then we'll dig down a bit deeper. You'll notice that land grant is primarily focused on generating best risk-adjusted returns, and as part of that falls on the upper end of the spectrum of risk asset exposure or return-seeking asset exposure. You're certainly not hiding on the low end of the spectrum and saying we only want to invest in conservatives. You're certainly out there and looking for the best opportunities and really have a very small allocation to cash and core fixed income as part of that strategy. And so this is largely driven by having a perpetual time horizon, being able to really look further down the road and not needing to worry about payout ratios or other investment constraints that you might have within a pension fund that could be paying out up to 15-20% of assets in any given year if they're very poorly funded. So the exposure to the publicly traded equities is, I would say, in line with the median as you look at that, but leans slightly lower. Not surprising, again, given that you have a fairly valuation-aware approach to asset allocation, and that's also baked into our approach to capital market assumptions as well. You do lean, I would say, a little bit more towards the less liquid markets. That's because typically the best risk-adjusted returns can be found there, and liquidity is not really an issue in a fund that tends to have a long perpetual time horizon. And so while it is above median, your overall exposure to the less liquid areas of the market is certainly not an outlier. In fact, I don't think you're an outlier in any of these categories. You're just very strategically leaning in certain areas relative to peers. Your exposure to traditional assets falls towards the bottom quartile compared to peers for all the reasons that we mentioned. This first quarter was a good indication of some of the risks in those markets. And it's been helpful that level of positioning in this more recent capital market environment. On page 359, we dive into the detail of the public implementation. Most plans have dedicated exposure to U.S. and non-U.S. equities. Some also use global, either exclusively or as a combination to the two more dedicated regional areas, but by and large, it's split between those, and that way investors can fine-tune their overall exposure. As I mentioned, your U.S. exposure is aligned with the median, and you do have a little bit more to non-U.S. just given the relative value proposition there. On the next page, 360, you see the fixed income implementation. Your exposure to core fixed income is largely driven by what is deemed needed in order to move through a major drawdown type of scenario. It is about half the median as a result of that. And your exposure to the non-core part, we've talked about the bifurcated nature there, with your core having quite a bit of duration or interest rate risk, your exposure to non-core really not having much of that, leaning more into the credit markets, is near the top end of the range. And again, that's also been helpful from a strategic positioning perspective. And while non-core is certainly above median, it's definitely, again, not the highest, not an outlier. On the next page, you can see the alternatives. That's sort of a catch-all bucket for anything that doesn't cleanly fit in the risks, including private equity. You can see that's at the median. Real assets and real estate are above median. Again, positioning that's been useful and has taken some time to get there. These are all also the less liquid areas, and it can be difficult to get your exposure precisely aligned with your policy or your target allocations, and that can create some friction. But for the most part, you've been pacing up to those targets and trying to deploy capital in a way that is prudent and makes sense. And then similar allocations across some of the hedge funds and risk parity, which is generally not utilized heavily. certainly not heavily compared to some of the other asset classes that I just mentioned. Fewer plans that have dedicated exposure, some do, but certainly not all. So I would say overall, your exposures make a lot of sense, certainly have been favorable in this changing environment. You're tilting towards the current market conditions and have been for some time, but are definitely not an outlier, extreme in any of these areas within the peer group. So I'll stop here, see if there's any questions or comments.
This is Tim. I've got to leave now. You all still have a quorum?
I don't know the answer to that question.
Well, we should have.
All right. Well, I appreciate the heads up, Mr. Mayor.
Well,
we do have one additional voting item. Andy, do you know if we still have a quorum?
Yes, we do. We do, Madam Chair.
Okay.
Great.
Okay. All right. Thank you. All right. Bye.
So questions on the black dot chart? Questions from council? Very good. Thank you for that overview. We're going to head now to agenda item 3H for Vince to talk about the Strategas macro research subscription.
Right, thanks, Madam Chair. So there's just a brief memo in your book. We use a variety of services within the office, to provide information to our investors, independent information to our investors. So our Bloomberg subscriptions, subscriptions to the newspapers and things. We do have a couple of strategy type services, and Strategas is one of them. We've been on more or less a trial price with them. And it's very much a service we're using. I use it every day. I know Mahal probably does too. And the rest of the staff has access and uses it. But we've got to come onto the permanent pricing with them, which exceeds the $50,000 limitation for an internal decision on an expenditure. So it's got to come to the council at the price that they've offered us. So it's a great resource for us. We've been using it extensively. It really feeds a lot of the stuff on the strategy side, but I know it's a nice round out for the asset class directors and analysts also. So it's coming before you because it exceeds that $50,000 limitation, and we recommend approval.
But Vince, just to be clear, this is not an actual voting item.
Yes, I think you've got to. We need your approval to make the expenditure.
Any objection to approving the expenditure? Okay, sounds like you have it.
Great, thank you.
We'll go next to the CFO report, agenda item 4A, Mr. Schiff.
Madam Chair, I'm on page, I guess it is 368 of the material. I just wanted to point out, this is the budget to actual through the end of April. If you note on the far right-hand column, it's showing budget savings of about $1.4 million. I have pointed this out before, but I wanted to make it clear within this schedule. We are currently paying for the management fees for the third quarter of the fiscal year. So we have to complete that process as well as the fourth quarter before the end of the fiscal year. Because of the lack of flexibility within the budget this year, and if you recall, last year was a very high return year for the assets, and because of the timing of submitting budget requests and how that actually works, we decided we'd go through, and I mentioned this, I think, a council meeting a couple of meetings ago, that we're going to request a bar to get us through the end of the fiscal year, just in case we might need it. And we did submit all the bar paperwork, and that was approved. And I would point out that for May, you will see the budget adjustment request appearing on the budget schedule, so that far right-hand column's going to be higher than what it is right now because of the additional budget request that we have approved. And then lastly, I'm on page 374. I just wanted to point out, and I think Steve pointed this out earlier, this summary that we're looking at that has $35.6 billion on it, this is as of the end of April. I think Steve pointed out within his information that he shares with the council as far as NAVs are concerned. The current NAV that we have that we're getting from JP Morgan is actually less than this, and people might say, well, why is that? Well, the current NAV that Steve actually cited is much more current than April 30th. So I just wanted to point out, since this report was prepared and you're seeing this total, we all know that the market has gone down. So I just wanted to prepare the council for that for next month. And then lastly, on the notes page, and this will be the last of my comments, I just wanted to point out on the notes page, which is page number 410, I think Steve mentioned that the contribution from the land office in that first bullet was $196 million. I don't think we've ever gotten a contribution from the land office higher than that, but I too wanted to thank the land commissioner for the hard work that her office does. And then for the third bullet down, I oftentimes get a question about the funding of the budget. I just wanted to point out where it says the fees column to reflect the bi-monthly administration fund transfers of 6.9 and 1.8. Related to the land grant permanent fund and the severance tax permanent fund. That basically is funding the budget. And we draw those out over the course of the fiscal year. And I just wanted to make sure everybody was aware of that. And then on the fourth bullet, I think someone mentioned that we did get a contribution related to the tobacco settlements. That contribution before the end of the fiscal year will be swept out. It's already spoken for, so we won't see any net inflows as a result of that. And then we had also on that next bullet, I guess that's 1, 2, 3, 4, 5, the fifth one down, we got a small transfer for the early childhood education program of $3 million. And I think that might have had to do with some budget savings that resulted at the end of the prior fiscal year. That's the reason that those monies had come in. And then also wanted to point out on the last bullet, because we've gotten feedback from the audit committee and others, I just wanted to point out that relative to the totals that we have as it relates to the NAVs, there are some NAV differences, timing differences that occur usually at the end of the month or at the end of the quarter. And if you're actually taking the investment holdings report and making a comparison to, any NAV information, there might be differences. And I think it only generally relates to timing differences as we transfer from our fiscal agent bank, which is Wells Fargo, to JP Morgan. Sometimes, just like you do with your own checking account, there could be checks in process or deposits in process, et cetera. And I just wanted to point out that that's the reason that you might have differences on that. Other than that, Madam Chair, I'm happy to entertain any questions that anyone might have on the material.
Very good. Thank you, Mr. Schiff. Questions on the CFO report? All right, then we will turn it over to Mr. Brown to present the retention of the Nossaman, Lowenstein, Sandler law firm.
Okay. Thank you, Madam Chair. This is Bruce Brown. We're actually seeking approval of two different law firms, so there can be two motions on this. Approval is sought here because both contracts may, although they won't necessarily exceed $50,000. The first law firm we're seeking approval for is the Nossaman Law Firm, which is a national law firm with offices in California, Texas, Washington, and Washington, D.C. And as is evident in the brochure prepared by Yulia Oriol, the Nossaman firm represents numerous pension funds and sovereign wealth funds and comes to us highly recommended. They have extensive experience negotiating with many of the same funds and general partners that the SIC has invested in and will likely invest in the future. As discussed earlier in the meeting, the SIC has pressing need to invest increasing amounts of capital in the private market. Accordingly, but the management team thought it was good to have a second team of lawyers working on this, and so we ask that the council today approve the retention of the Nossaman Law Firm to provide investment legal services. Do you want to take a vote on Nossaman first, or do you want me to present Royalties firm as well?
Why don't you present them both, and then we will take votes.
Two votes. Okay. The second law firm we're seeking to retain is the Lowenstein Sandler Law Firm, which is also a national firm with offices in New York, New Jersey, California, and D.C. The need to hire Lowenstein Sandler arises from the council's 2004 decision to invest in the UKIPA American Alliance Fund. As a result of UKIPA's investments in the Allied Trucking Company in 2006, UKIPA has been involved in litigation since 2009. Allied was in bankruptcy when UKIPA invested in them, and they went into bankruptcy again in 2012. After extended litigation in the bankruptcy court, the trustee in the new bankruptcy matter in 2021 sought to recover a judgment obtained against UKIPA from the limited partners on the purported grounds that all of UKIPA's distributions to the limited partners after 2017 could be reversed as fraudulent transfers. After an abbreviated RFP process led by the UKIPA limited partners with the most at stake, Lowenstein was hired to represent all the limited partners in the fraudulent transfer litigation. In recognition of its responsibility for this problem, UKIPA agreed to pay a substantial initial retainer for the LP's representation. The LPs then agreed to pay fees after the retainer was spent. The State Investment Office agreed to pay its pro rata share of these fees, capping its obligation at $50,000, in keeping with the SIO's contracting authority, with a limit on their contracting authority. Based on the money at risk, the SIC's pro rata share of fees is 2.5%. And to the extent that legal expenses are applicable to the SIC and fewer than all LPs, like the sovereign immunity expense, the SIC will pay a pro rata share relative to other affected LPs. So other LPs that have the same defense will share in those expenses. To date, the SIC has paid less than $30,000 for its representation. The fees that have been paid are equal to less than 0.5% of the SIC's potential exposure in this matter. So in terms of efficiency and cost, there is no reasonable alternative to the Lowenstein firm to protect the SIC's interests. Accordingly, today, we are seeking council approval to continue having the Lowenstein firm represent the SIC if and to the extent that fees exceed $50,000. Thanks. Any questions? I'll answer any questions.
What's the kind of timeline on how this proceeding is moving through?
Well, it's crazy. Because, I mean, it has literally been going on for more than a decade, some form of this litigation. The limited partners are only involved because they're looking for deeper pockets, so it's kind of unusual. But UKIPA has been involved in this litigation forever. For a long, long time. And now they're just seeking to get money back from the limited partners on the ground that UKIPA should never have given it to us because claims they've made in various courts. But in terms of settling this thing, we're sort of at the tail end of it. So most of this litigation has happened before the limited partners are really not a major part of this. As for instance, the suit against limited partners was filed in October last year. And we were actually, the SIC was actually sued both in Delaware and in New Mexico because they were afraid about jurisdiction. But the New Mexico case has been stayed indefinitely. And the Delaware case, this is a Delaware bankruptcy case, was filed in October last year, but we still haven't, the limited partners still haven't filed an answer for a motion to dismiss. So nothing's happened there. I think everybody's hoping that this be settled without much further litigation, given how much litigation has already happened. But who knows? I mean, there's still issues about dividing up this responsibility between the partnership, the limited partners, and new Ukaipa principals, which may go on for quite some time. But through all of this, and the good news is for us, we have a relatively small share in this, and there are two large pension funds that have an enormous amount of money at stake. So they're paying very close attention to this and are on top of most of the issues all the time. As are we. We're on top of it as well, but because we've only got a limited share, we're not going to be responsible for much of the settlement for legal fees.
So Bruce, what's our general exposure to liability from bankruptcy proceedings as limited partners and funds? Like, is this a bank?
This is Evan.
Very rare.
Let me weigh in here.
Yeah, Evan. Yeah, hey, Evan.
I'm here. We're getting a little more complex, so let me weigh in for a second. First, I'm going to be a little general in the response because this is an open meeting. We don't get at privilege issues. This sort of case is very unusual. It's very unusual that a bankruptcy court would ever go after LPs because of the LP status. So, not common. Arguably might not even work because of that factor. And so that's one of the things that everybody's litigating. There are 20 LP defendants here. I'm giving public information. And so because of that, we have very little cost to pay because we're only about 2% of that 12 of those 20 funds. So it's a good economic arrangement. We're protecting our interests. It's going to go on for a while because there's legal stuff and all sorts of problems with legal claims potentially. And so we're just, in an abundance of caution, protecting our interests to the maximum extent by sticking with the group. And again, having this great 2% sort of expense load subject to the amount that plus an additional amount, a big amount that the GP has paid. I don't think you'll see a lot of these cases. They're very difficult. And I think that was your question. But
I had never heard of this exposure before, so yeah, okay.
It's uncommon, and it's very rare so far, but who knows?
Okay.
Madam Chair?
Sorry.
Madam Chair?
Member Messina.
Yes, thank you, Madam Chair. There are two types, my understanding, of fraudulent conveyance issues in bankruptcy. One is because there's actual fraud alleged. The other is because the transfer was made within a certain time period before the bankruptcy was filed. And if it was within that time, it's subject to being recouped. Do you know if this fraudulent conveyance claim is of which type? Are they claiming
the plaintiffs are claiming constructive fraud here because Ukaipa is not actually in bankruptcy. So it's not like this is some adversary proceeding where they're just trying to get a preference redone. The thought is that because Ukaipa was insolvent at the time the transfers were made, the trustee can come in and get the money from them. So it's kind of confusing because Ukaipa itself is not in bankruptcy. It's actually the Allied Trucking Company, or now known as Shin, which is in bankruptcy.
Thank you.
Thank you, Member Messina. Further, Madam Secretary.
So I'm going to take us back to the approval part of this conversation, and so a couple of things that come to mind when I see this is I just realized, so agencies have the authority or the ability to enter into contracts up to $60,000, and then anything over that, then it becomes a different procurement process. And so I'm wondering, one, I think maybe sometime in the future we need to look at maybe expanding the approval authority that, or that what the council has to bring to us, what the staff has to bring to us for approval, to maybe 60,000 to line up what professional service contract cap is. But then secondly, do we anticipate that this particular contract is going to exceed that $60,000? Because if that's the case, then we may be looking at a different procurement process moving forward.
Well, this is considered, okay, go ahead, Evan.
Okay. One, it's always possible it could go above that, but, you know, as fiduciaries, we need to defend it, and we're in a pretty good shape. And, you know, relative to what Member Messina pointed out, there's all sorts of complex issues about, can you do this? Is it an appropriate bankruptcy case? And that sort of stuff can get costly. And some of them are very specific issues, like sovereign immunity and so forth, relative to states. As to the second point about procurement, we're in a very fortunate position as the SIC because we're procurement exempt for this, as well as 99% of our contracts. Under 13.1, I believe it's 13.198CC of the procurement code in our statutes, we're exempt from investment-related contracting. And this is an investment in which they're trying to claw back or claw out distributions we received. So we are not subject to the $60,000 threshold, if you will, for purposes of any sort of contracting like this. So we're allowed to contract in the way we are.
So, but Madam Chair, we're not contracting for investments, we're contracting for attorneys.
We're contracting for investment-related litigation. Our statute says investment-related, and obviously when we get a distribution that's from an investment, and we process that investment and somebody tries to call back that investment, it's clearly investment-related.
Okay, I think I'd like to explore that a little bit deeper. So thank you, Madam Chair.
Great. All right, so do we have further discussion or do we have a motion? So we're going to take both of these separately. Councilman first. Do we have a motion to approve the contract?
Madam Chair, I'll be happy to do it, although I got to think the council might be tired of hearing my voice. Based on the recommendations of the SIC staff, I move the State Investment Council retain legal services with Nasserman LLP for general corporate work contingent upon the Mexico legal requirements, council policies, negotiation of final contractual terms and conditions, and completion of appropriate paperwork.
Do we have a second?
Second, John.
Okay, we've got a proper motion from Member Lavender, a second from Member Bingaman. Any discussion on the motion to approve this contract? Hearing none, we'll go to a roll call vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Mr. Rawson.
Yes.
Mr. Bingaman.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Mr. Lavender.
Yes.
Madam Chair, the motion is unanimously approved.
Okay.
Okay, moving on to, based on the recommendation of the SIC staff, I move the State Investment Council retain legal services with Lowenstein Sandler LLP for legal defense contingent upon New Mexico legal requirements, council policies, negotiation of final contractual terms and conditions, and completion of appropriate paperwork.
I'll second it.
All right, we've got a motion by Member Lavender, second by Member Messina. Any discussion on the motion? Hearing none, we'll have the secretary call roll.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Mr. Roston.
Yes.
Mr. Bingaman.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Mr. Lavender.
Yes.
Madam Chair, that motion is unanimously approved.
Very good. Thank you very much, Andy. And thank you to Mr. Brown and Mr. Hand. Moving on to agenda item 5A, any old or new business before the council? Hearing none, our next SIC meeting will be Tuesday, June 28th, and please stand by. We believe that's going to be in person, but I'm assuming Mr. Moise will let us know.
Yeah, that's correct, Commissioner, and we will keep our eye on any changes in the code status.
And then moving on to public comment, Mr. Woolman, is there any public comment to be read before the council?
Madam Chair, just one. It's really short. I'm going to go ahead and read it now. Hello, my name is Olivier Goins. I am the VP of Administration for Polynatura Corp., located in southeast New Mexico. I am interested in making an introduction of our Ochoa project to the council so it may be considered for future investment. I would be grateful if given the opportunity to provide a short introduction brochure to the council. Thank you for your consideration and your help. Regards, Olivier Goins. We'll follow up at the staff level, Madam Chair.
Thank you. All right, with that, I will take a motion for adjournment.
Sarah Lavender, so move.
And a second?
I'll second.
All right, we've got a motion by member Lavender, a second by member Messina to adjourn. Any objection to an adjournment motion? Hearing none, we are adjourned. Thank you, folks.
Thank you.
Thank you, everybody. Bye, everybody.